Coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube size concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, e-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
for every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pelleto. Volatile Thursday. The Dow lower, S&P, NASDAQ are both higher. Stocks have been swinging between gains and losses after the biggest rout since November as investors reassess valuations amid the Fed's latest signal that it will move aggressively to tamp down inflation. We've got the 10-year down 6/30 seconds. 10-year yield 1.72%. Spot gold down 1.3%, 17.87 the ounce. Crude up 1.9%, 79.31 the barrel on WTI, and Bitcoin now down 0.6%, 43,353 on Bitcoin. S&P up 8, up 0.2%. NASDAQ up 35, up 0.2%, and the Dow now lower by 114 points, down 0.3%. Federal Reserve Bank of St. Louis President Jim Bullard says Fed policymakers could start to raise their target interest rate as soon as March and shrink the central bank's balance sheet as a next step in response to surging inflation. Well, as for the inflation backdrop and the Federal Reserve, Seema Shah is chief strategist at Principal Global Investors.
We do see inflation coming down from the levels that we've become accustomed to in the last 2 or 3 months. But at the same time, although it's coming down, we're still likely to see inflation settling at a level which is higher than what we've seen over the last 10 years. Right, so this is a kind of above the 2% target, and it's something that the Fed inevitably has got to respond to.
And again, we do have the 10-year right now at 1.72%. Oil at a 7-week high as supply constraints from OPEC Plus to North America offset concerns about the impact of a COVID-19 outbreak in China. Oil shares are higher today. ExxonMobil, for example, up by 2%. BP up 1.8%. Chevron up 0.5%. EOG Resources up 1.6%. Pioneer Natural up by 2.8%. Stocks mixed. S&P up 1/10. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I do feel like it's the morning after, the afternoon after.
It does feel, yeah, it does. Well, I think there's this, if you're in New York City, there's this sort of impending doom with the first snowstorm of the year coming.
Dun.
Yeah.
Will it be 2 inches? Will it be 4? Will it be 5? Will it be nada?
Will school get
canceled? Will it be rain? I know.
That's all we care about.
I just remember the siren
all
that
we care
would,
about.
6 a.m. and 7 a.m. it would go off.
Yeah, I don't think these days they're looking to cancel school for any reason.
Welcome, everybody. Live at our Bloomberg Interactive Brokers studio. We are streaming on YouTube. Yes, it is Thursday, January 6, 2022, just our first week of 2022, but feels like a lot has already happened. 1 year ago, we were kicking off our broadcast watching as chaos was unfolding at the U.S. Capitol. That is certainly on our minds and among our coverage on this Thursday. We'll get more to that a little bit later on.
Yeah, more on that, plus volatility. Well, it's back this year. The stock's swinging between gains and losses after the biggest rout since November following yesterday's Fed minutes. We're going to have much more on the markets, and especially tech stocks, a little later today.
Yeah, VIX rallied yesterday, up just a hair today, little changed, if you will. Got a lot going on. In keeping with the Fed, if you're under 40, you've never seen a hawkish Fed. That story among our most read on the Bloomberg. We'll get to that. And then on that insurrection a year ago, the role of Facebook and Twitter and what's changed.
Also, in the new issue of Bloomberg Business Week, we deal with our latest surge of COVID, a story on how the pandemic is reversing 25 years of progress for the world's girls. It's also today's big take from Bloomberg.
And did you know you should maybe cash out your IRA and pay off your mortgage, according to one of our guests?
I did not know that. But yes, our guest later this show is saying that and some other unconventional ideas for retirement.
All right, we're going to get to that in just a moment. First up, we got to get to the market drivers report. Let's get to the Business Week agenda. Both on the phone in our New York City bureau are being very safe amid the rising COVID cases. Crude Gupta, Bloomberg Markets correspondent at Bloomberg News. So too is Michael McKee, international economics and policy correspondent. Mike, I want to start with you because I do feel like coming off the Fed minutes, we are going to be glued to every data point. We got a drop, a batch today, if you will, and then of course a big one tomorrow. How do you see it? What of the data we got today is interesting to you?
The most interesting came from the ISM Services Index because it dropped. It went to 62 from 69, and that is still high, but it was a significant drop, and it suggested maybe some Omicron issues in the month of December as people stayed home and didn't go out on face-to-face to visit service businesses. So it'll be interesting to see if that continues as this month goes along. Tomorrow's the big one with jobs, and we'll see whether a lot of people went back to work as suggested by ADP or whether the hiring was slower as suggested by the ISM.
And it's all of the month, so any Omicron concerns, is that going to be reflected in the data points?
No, the government's hiring numbers, the BLS puts together, are from the payroll period that includes the 12th of the month. So basically the beginning of December when Omicron was not such a big deal. So I don't know that we're going to see enough of an impact to be able to point to it and say, well, this was because of the variant.
Yeah.
Obviously, the Fed will be watching as we go forward.
Well, I think back to that part of December, people were still learning how to say Omicron and also still being able to find rapid tests at
I'm still figuring it out.
Local pharmacies.
Omicron.
Yeah. Hey, Crude Gupta, come on in here. Hey, I know you were out yesterday, but you missed a heck of a day.
I know. I had major FOMO when I was going to call sick, and I was just going to say, you know what, it's fine, nothing's going to happen. It was a quiet Tuesday, and then bam, sell-off.
Well, so help us make sense of what's going on today or a lack thereof as stocks kind of struggle for direction.
Yeah, well, what's interesting here is that stocks aren't the story today. I mean, it's no surprise here when the Fed is on everyone's mind. The stock market had a brutal sell-off yesterday, one that I missed, very sadly. But as journalists, we love to look at those sell-off days as those good, fun days. But today you're seeing a little bit of a rebound. What's interesting to me is that the NASDAQ, for example, tech really led the sell-off yesterday. Today, in theory, it should actually rebound, and you're seeing it flat on the session. Just technically speaking, when you have a really big sell-off, it should bounce back, and it's not, which tells you that there might just be some very sustained pressure in big tech. Now, remember, this is very normal when you hit record highs, and especially for the $1 trillion milestone on Apple that we hit on Monday. You tend to see some tech pressure following those days. So this is pretty normal, but the real action, like I said, is going to be in the bond market. To what Michael McKee was saying, this is all about how quickly the Fed is going to hike. And if you look at some of the bond pricing, it's not just the 3 hikes that were priced in, say, a couple of weeks ago or even indicated on the dot plot. There is a 4th hike priced in there telling you that 2022 might be a very aggressive year for the Fed.
Or not. Mike, I don't know about you, but I'm data dependent.
I'm data dependent as well. A lot of economists are looking at what happened in the markets yesterday and scratching their heads because the Fed didn't tell us anything new. These were minutes of the meeting at which they agreed to change their view on the number of rate increases from less than 1 to 3. They upped their inflation views and they upped their growth views and lowered their unemployment views at that meeting. So there really wasn't anything new that was presented, and it's kind of odd that markets all of a sudden thought they discovered something different. The language that got people's attention was when they said we might move faster than previously anticipated. But their previous anticipation was in September, the last time they did an economic forecast. So it's not a change from yesterday to the 15th. It's a change looking backwards. So I don't think you're going to. I don't think things will be necessarily as volatile from the Fed's point of view as people in the market seem to think right now.
Gabby, really quick, 20 seconds. Bullard, his comments, significant? We watch him.
Yeah, I mean, it just tells you what we already know is basically where we are with him and with Mary Daly today.
All right, sounds like you're just brushing it off. All right, this is why we love Michael McKee and we love Kriti Gupta. We are set up on this Thursday. Kriti, thank you so much. We'll be back a little bit later on. Michael McKee, International Economics and Policy Correspondent.
Let's do the Bloomberg Business Week Bite of the Day. It's one number that tells us a lot. Today's number, $5.5 billion.
Societe Generale's car leasing arm, ALD, agreeing to buy competitor lease plan for $5.5 billion in cash and stocks. Merger will create a global player in mobility with a total fleet of about 3.5 million vehicles. I already know, I think 2022 is going to be about EVs, mobility, what happens in the car space again.
Again, I mean, look at what's going on with Rivian today, for example.
Is that a decliner?
Yeah, one of my decliners.
Nice deep tease there. All right, let's get to world and national news. Nancy Lyons in the nation's capital on what is safe to say a historic day here 1 year later after the riots. Hey, Nance.
It is a somber day today. President Biden says democracy remains at risk a year after the attack on the U.S. Capitol. He blames former President Trump for leading that attack on our elections.
For the first time in our history, the president had not just lost an election, he tried to prevent the peaceful transfer of power as a violent mob breached the Capitol. But they failed.
Biden, speaking in the Capitol's Statuary Hall, says it's important now that lawmakers take steps to secure voting rights to prevent Trump loyalists from restricting ballot access in states all across the country. Senate Minority Leader Mitch McConnell has issued a statement today saying that Democrats are trying to exploit the anniversary to advance partisan goals like filibuster reform. More of us are opting for apartments with U.S. occupancy at an all-time high. We get details from Bloomberg's Amy Morris.
Anyone looking for a new place is going to have a hard time finding one. Data from the property management software company RealPage shows 97.5% of professionally managed apartment units are spoken for as of December. That's more than 2 percentage points higher than the occupancy rate in December of 2020, a difference representing hundreds of thousands of households. RealPage says not only is that a record, typically they consider 95 to 96% to be essentially full. Amy Morris, Bloomberg 99.1 and 105.7 FM HD2.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, thank you for that. Nancy Lyons in our D.C. bureau. And D.C. is definitely on our mind. I think about 1 year ago, first of all, it feels like 10 years in some regards. Yeah, and I remember we kicked off our broadcast and we were just watching unfold in the U.S. Capitol, the breaching of the Capitol, the riot, if you will, the insurrection. And what I felt like, first of all, it was all happening in real time, right? We were trying to cover it, keep up, talk with our team that was in the Capitol to some extent, and they were under lockdown. But what's interesting, in the days afterwards, I realized we had one camera or a camera that was seeing one feed, and as more video came out and more information was known, and especially those visuals, I realized it was a lot more serious than what I initially thought.
Yeah, I think a lot of people, it was, and I think a lot of people started off their day hearing comments from Vice President Kamala Harris and President Joe Biden. Today, in commemoration of what happened 1 year ago. And it struck me that Vice President Harris made the comment, she made it out like a day that, you remember where you were when you heard about it, when it was happening. Similar to December 7th, 1941, she said. Similar to September 11th, 2001. And certainly that's indeed the case for me. And I think it's not just because we were covering it, Carol.
Well, no, exactly. And it's kind of jarring now when you go to the nation's capital and you see everything, especially right afterwards. But it's a very different Washington, D.C. because of it. A lot more protection, a lot more fences up, if you will. The president, though, coming out and warning the insurrection at the U.S. Capitol, part of an assault on democracy that Donald Trump and his supporters are continuing to wage 1 year after the deadly riot. His speech was his most detailed rebuttal yet of the effort by Donald Trump and prominent Republicans to raise doubt about the results of that 2020 election and rewrite voting law state by state. He was pretty fiery and he was pretty specific.
He was. He wasn't so specific, though, to actually mention President Trump's name. He did identify the former president as the leader of the campaign to undercut the results and incite his supporters to riot at the Capitol, but he didn't say the words President Trump.
Yeah, coming up in just a moment, we're going to talk a little bit, too, about the role of social media in helping create a political divide and really helping maybe potentially, provide some momentum in that breach of the U.S. Capitol. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow lower, S&P, NASDAQ, both higher. Stocks swinging between gains and losses after the biggest rout since November. Investors reassessing valuations as bond yields remain elevated. The 10-year right now, 1.72%. 10-year's down 5/30 seconds. Stocks mix. The Dow lower by 111, down 0.3%. S&P holding on to a 5-point gain, up now by 0.1%. At one point, the S&P was down 29 points today, down 0.6%. NASDAQ is up 28 points, up by 0.2%. Spot gold down $22 the ounce at $17.88, a drop of 1.2%. West Texas Intermediate crude up 1.9%, $79.35 a barrel on WTI. Bed Bath & Beyond shares, a darling of so-called meme stock traders, rising sharply despite posting quarterly sales at missed estimates and reducing its outlook. Bed Bath & Beyond shares, they're up now by 10.1%. Recapping, stocks mixed, S&P up 3, up 1/10. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Appreciate that update. Carol Massar, Tim Stenovic here on Bloomberg Business Week in our Interactive Brokers studio. So as we mentioned earlier, 1 year ago today, the U.S. Capitol was breached by supporters of Donald Trump, storming the Capitol, transforming the global conversation around democracy in America. Today, the U.S. is more divided than ever, and a factor in that division, Tim, I think it's safe to say the rise of social media and the dominant players in that space. We're talking about Facebook and Twitter.
Yeah, no question about that, Carol. Naomi Nix, a social media reporter for Bloomberg News. She joins us on the phone from our New York City bureau. Naomi, as we think back to what happened a year ago and more to what happened in the wake of a year ago, and I'm talking about Facebook and Twitter kicking Trump off of its platforms, how should we think about the role that social media companies have taken since then? Like, is it changed at all when it comes to trying to police their platforms?
Well, I think in one significant way it has changed, right? And that is what you just mentioned, that Facebook, Twitter, and YouTube actually and others made moves to kick Trump off their platforms. It was one of the most aggressive, actions to date on a political leader and a government for violating their sort of content rules. And, that is a notable because social media companies have traditionally shied away from trying to be the, quote, arbiters of truth. They like to have a hands-off approach on political content. Having said that, there are other ways in which, there are a lot of risks that are still remain. So social media companies are still spreading content that erodes trust in the democratic process. There is still misinformation about what happened on 2020 on some of these social media platforms. And they still sort of have these struggles to balance growing their social networks with taking a more proactive approach on some of this content.
I have to say, Naomi, a line in your story, a year later, social media companies still don't appear to have figured out how to put out these kinds of fires. So it says to me the role of social media in igniting another round of fires, political or other, it could still happen.
It could, right? So right now we have, particularly on the right, a continued drumbeat about whether the electoral process is fair, whether there's widespread fraud. We still have misinformation spreading about that. So that's going to be a challenge for social media companies. And we're heading into the 2022 midterm elections in which companies are going to have to be policing that kind of misinformation in small, hyper-local races across the country. And that's going to be a challenge.
What does 2022 hold for the former president and getting back on these platforms? Is he going to be able to get back onto Facebook, on Twitter, and on YouTube?
So he's banned for 2 years on Facebook. He's permanently banned from Twitter. And so, that's going to be difficult for the midterms. But, we'll see what 2024 holds and whether he runs again and whether he'll be able to get some of his social media access back. But I think it's important to know that there are other political leaders following in his footsteps, peddling misinformation about the election and also, COVID-19. We saw Facebook and Twitter make moves earlier this month to suspend Marjorie Greene over spreading COVID misinfo. And so Trump might not be up for debate on these platforms, but there are other public figures who are.
Right. And what's interesting, my husband shared with my daughter and I a Politico story today, and the headline on it is that they stormed the Capitol. Now they're running for office, and it talks about at least 57 individuals who played a role in the day's events, including some who were arrested on charges related to the Capitol attack, now are running for office in 2022. So politically, we'll continue to feel their impact. When it comes to social media, though, and Donald Trump specifically, he's developing his own media platforms. How do you think about that, and how do you think that might factor in, and how they might police maybe what they see as more liberal views?
Yeah, look, so there's definitely alternative social media platforms that Trump and other folks who feel they're being treated unfairly by the mainstream outlets can flock to. You know, we saw that with Parler and Gab. I think, though, it's very much true that the mainstream players, Facebook, Twitter, YouTube, they have the dominant platform, and these smaller platforms aren't going to be able to give people like Trump the megaphone that they once had. And we saw some results. There was actually a study that the Washington Post covered from Signal Labs, that documented how some of the misinformation around the election declined in the wake of Trump's deplatforming. And so I think it'll be difficult for Trump to be able to match that kind of reach with his own platform.
Hey, Naomi, before we let you go, and just in our last 30 seconds that we have with you, talk a little bit about what was happening at Facebook on January 6, 2001.
Yeah, I mean, look, Facebook took down one of the Stop the Steal groups, but what would happen is it was kind of a game of whack-a-mole. Another group would pop up and it would grow really, really rapidly, and the company struggled to address those ballooning pages and group who were spreading misinformation about the election.
Interesting. And social media, continuing to get caught in the hairs of all of this. But I think about, Tim, how many people get their news from there? And so you have to think about what's the responsibility of them in terms of the platforms.
Are they platforms? Are they media companies? And also, Twitter's new CEO, what role does he play in managing that type of stuff on the platform? I think that still remains to be seen, since he's been there, in the CEO position for such a short time.
And traditional media is increasingly becoming social media as well, and yet there's a responsibility about what goes on those platforms. All right, you're listening to Bloomberg Business Week. Our thanks to Naomi Nick, social media reporter at Bloomberg News.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
This is Bloomberg Business Week, and coming up, we're going to get our latest check on the daily COVID headlines. We'll do that with Dr. Ian Lustbader over at NYU Langone.
But first, a check of the markets and trading day. Here's Charlie Pellet.
Looking at a mixed day right now, we do have the Dow Jones Industrial Average down 129, down 0.4%. S&P up 6, up 0.1%. Big recovery there. Have been down as many as 29. Nasdaq up 32, up by 0.2%. Bottom line here, stocks have paired gains. Bond yields remained elevated. We have got the 10-year yield now 1.72%. Spot gold down 1.1%, 17.89 the ounce, and West Texas Intermediate crude rallying 2.1%, 79.46 a barrel. Lots of debate in Washington about the messaging from the Centers for Disease Control and Prevention when it comes to isolation and quarantines. Dr. Chris Byrer is a professor of epidemiology at the Johns Hopkins Bloomberg School of Public Health.
I do think that they really need to do more coordination across the government, across the administration. And the CDC leader has important roles to play in that, but isn't and shouldn't be the chief voice of the policy decision. She needs really to be the scientific surveillance, data-driven voice.
Dr. Chris Byrer of the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Recapping stocks mix, S&P up 5, up 0.1. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So billionaire and Virgin Group founder Richard Branson and his wife among the latest to report getting COVID. Branson, they've said to have a mild case. We are seeing a shortage of at-home tests and trying to deal with that as well.
No joke. I do feel like I have more friends right now with COVID who are in isolation than those who aren't.
Yeah, every time I get on the phone with somebody.
That's anecdotal, but we see it playing out in the data too.
All over the place. Hey, let's get to our daily roundup when it comes to the pandemic and COVID headlines. Dr. Ian Lustbader back with us, clinical professor of medicine at NYU Langone, on the phone in New York City. And we know that you are under the weather as well, so we wish you well. How are you doing? But you don't have COVID, correct? Or at least you haven't tested positive. Is that right?
Right. No positive tests yet. I've had 2 antigens negative and a nasal swab negative for flu. My bet is when I test later today, I would not be shocked if it's positive. Basically exposed, as we all are, to many patients who are asymptomatic, who have COVID. And that's really part of the reason it's spreading so much, is because people can spread it before they have any symptoms.
What are the symptoms that you have right now?
Really primarily a laryngitis and classic upper respiratory symptoms, nasal congestion, sore throat, mild cough. That's really the classic Omicron symptoms, as opposed to the original Alpha variant, which was much more deadly, much more lethal, with really lower respiratory symptoms. So we're seeing this huge spike in cases, slight increase in hospitalizations, not dramatic yet. The death rate fairly flat, so we see that this is very contagious, kind of mild to moderate symptoms, with no significant increase in deaths at this point.
Hey, Dr. Lustbader, I just want to make sure I get this right. The 2 antigen tests that you took, those are also known as rapid tests, right? Those tests,
correct.
Those showed that you do not have COVID. And then the nasal swab you took was for the flu. You've tested negative for the flu, but you haven't yet taken a PCR test for COVID.
No, the nasal swab was a PCR test, and that was for, it's a double, it's called a LIAT. It's a rapid test, which we have available in some centers. And the turnaround is amazing. It's like 30 minutes or less. And that tests for flu and PCR for COVID-19.
And that didn't, you said you didn't have it, though.
That's right. But all of these tests are not perfect. We see long lines. People are getting tested for no symptoms or mild exposure. So really there's, I don't want to say we're running out of tests, but there's a very big demand. And really, we're not changing the way we treat people at this point. A very select group get monoclonal antibodies. The prior monoclonal antibodies have been shown not to be that effective. So we do have, for elderly people or people with underlying significant disease, COPD, et cetera, there is some monoclonal antibodies. And of course,
Paxlovid from Pfizer, the oral medications. But really, a lot of this is just symptomatic, stay home, rest, fluid, hydration, and it seems to resolve within, 6 to 10 days.
And you are triple vaccinated, correct?
Yes, triple vaccinated. But I know patients who have had COVID, 3 vaccines, and have still gotten Omicron. So, we know there are 32 mutations, 30 plus in the spike protein. So really, this is able to evade a lot of the prior vaccines, which are still alpha vaccines, right? So it's been a number of variants. And, this may become endemic. There may be sort of a yearly seasonal COVID. We've talked about that. But we will need to come up eventually with a more specific both treatment and probably prevention in order to prevent this from becoming more seasonal. But at this point, I think we're going to reach our peak in January. Probably by end of January, February, we'll see cases drop, mainly because everyone will have been exposed and there'll be, to some degree, herd immunity, at least for this round and for this variant.
Tim and I were talking about that earlier. We keep overhearing from various individuals, well, we're all going to get this. We're all going to get this. And we certainly have heard it from the likes of you and others in the medical community. At the same time, it's hard not to still, after 2 years and counting of doing everything and anything to avoid it, the thought of, okay, in the end, we're all going to get it. Having said that, Dr. Lustbader, and you're so gracious to come on with us because we can hear it in your voice, and we hope you're going to get a lot of rest after we finish our conversation. Is there still the possibility of another variant? And as you said, it's multiple mutations in Omicron. Should we anticipate that there will be another variant possibly after this that could be even more problematic?
Personally, I don't think so. I think this widespread herd immunity, at least in the U.S., will keep most everyone safe. The Omicron did develop in South Africa, so it's a big world. There are 8 billion people. It's hard to say for sure there won't be a son of Omicron, which is possible. This does seem to be very, displacing the alpha and deltas. It's highly contagious, very efficient. Personally, I think Omicron will be kind of the end of the global pandemic. I think everyone will get it. Most people will do fine. We'll get antibodies. I don't think there's going to be another variant, but it's certainly possible. And hopefully it will be much milder, but we don't know for sure.
Well, we're certainly sending you our best wishes, Dr. Lustbader. Really appreciate you taking the time on a day when we know you're under the weather to share with us not only your experience, but your outlook for the next few months.
Yeah, take care. Get better soon and definitely go rest. And our thoughts are with you. Dr. Ian Lustbader, clinical professor of medicine at NYU Langone Medical Center, on the phone in New York City. As he said, so far he hasn't tested positive for it. But, this is the tricky part of testing. You and I talk about this a lot.
I want to send him some soup.
I want to send him some soup.
Sounds like he needs some soup.
Yeah, I hope he takes some rest and just really takes care of himself. He is vaccinated, and from what we hear from a lot of folks, that when you are, that certainly can put you at a great advantage.
Well, let's head to Washington, D.C. now for a check of the latest world and national news. Nancy Lyons is standing by. Hey, Nance.
Thanks, Tim. President Biden is remembering what happened at the U.S. Capitol a year ago today. He gave a speech this morning from Statuary Hall, where a riotous mob clobbered police and then hunted down members of Congress. Bloomberg's Irv Chapman has more from Washington.
The president denounced his predecessor, Donald Trump, for his role in bringing on the mayhem.
He tried to prevent the peaceful transfer of power as a violent mob breached the Capitol. A president who had just rallied the mob to attack, watching it all on television and doing nothing for hours.
The president suggested that Trump's big lie in denying he lost the election is still poisoning the political atmosphere and threatening the legitimacy of forthcoming elections. In Washington, Irv Chapman, Bloomberg Radio.
The #1 men's tennis player, Novak Djokovic, is confined to an immigration detention hotel in Australia as he awaits a ruling on whether he can compete in the Australian Open later this month. Djokovic is a vocal skeptic of vaccines. He obtained a medical exemption to Australia's strict vaccination rules before setting out for the country, but then when he arrived, border authorities rejected it. Australian Prime Minister Scott Morrison is defending his nation's policy.
If you're not double vaccinated and you're not an Australian resident or citizen, well, you can't come. And many countries have those rules around the world, and we have them, and they've been very important for securing Australia during the course of this pandemic.
Morrison says there are no special cases. A hearing in the Djokovic case is set for Monday. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, folks, you're listening to Bloomberg Business Week. Carol Master along with Tim Stanovic. And Nancy just mentioning a story that maybe we can sit upon. I mean, this has been out in the news for the last week or so, right? And we were just talking about, or Nancy was, the family of, or talking about Novak Djokovic, but his family accusing Australia of trying to deny him a record 10th Grand Slam victory in Australia, and his country's president announcing what he called a political campaign over COVID-19 protocols.
Yeah,
This is ugly.
Yeah, it is ugly. So just to catch everyone up, so Djokovic's lawyers have mounted this legal challenge against Australia's decision to hold him at a hotel used for detaining refugees and then expel him after federal officials overruled a state vaccine exemption for the tennis star that sparked a national uproar. So earlier this week, he was told that he got a medical exemption to play in the Australian Open. So he flew to Australia and then was essentially denied entry to the country because he was overruled by politicians.
Yeah, it's what I don't understand is, like, I was looking into flying somewhere overseas, and like there are lots of protocols and rules.
I know.
And government's very involved before you can even get on a plane.
Yeah.
And like you have to do certain things. So and did he fly on a private plane so he could just do it? I'm a little confused here.
Well, he in order to actually enter the country under the pandemic rules, you have to prove a certain number of things, including that you're vaccinated or actually have a medical exemption. He was granted earlier a medical exemption to enter the state of Victoria, but the federal government revoked that after officials questioned the athlete for hours at Melbourne Airport.
So it's interesting, like, why did it get to that situation? He's going to remain in detention following a court's decision to cancellation. This is from the AP reporting that out on today, actually. And the court's going to resume proceedings Monday morning. So he just sits there?
For now. He's not playing tennis.
When does it begin?
I don't know when the Australian Open begins, but this is, he's widely viewed as the best tennis player, among the best tennis players ever.
I've seen him play. He's phenomenal.
It's amazing.
All right, you're listening to Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got the Dow lower, S&P, NASDAQ. They're both higher. Stocks have been swinging between gains and losses after the biggest rout since November. Investors are reassessing valuations amid the Fed's latest signal that it will move aggressively to tamp down inflation. S&P 500 index, little change now, up 0.2%, higher by 10 points. The NASDAQ Composite Index, so big story there, was down 185 points, down 1.2%. Right now, we've got NASDAQ up 43, higher by 0.3%. Dow Jones Industrial Average lower now by 109, down 0.3%. NASDAQ 100 Index up by 0.4%. Bitcoin slumping 4%, 43,449. 10-year yield now 1.72%. Spot gold down 1.2%, 17.89 the ounce. While West Texas Intermediate crude oil up 2.3%, 79.67 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. It is Thursday, January 6, 2022. The new issue of Bloomberg Business Week, by the way, out on newsstands. It's also online at businessweek.com, and also on the Bloomberg terminal. Now, as we continue to battle the pandemic, we similarly, I can't speak. I'm ready for Friday. We also continue to tally up the cost of it around the globe. And Tim, Bloomberg Business Week really gets into it this week about the progress when it comes to women, especially in those developing countries.
Let's get into it with Jill Filipovich, freelance writer for Bloomberg Business Week. She joins us on the phone from Brooklyn. Jill, for 25 years, girls in developing countries have been on this remarkable trajectory of progress. But the pandemic is reversing that. What did you find at the Girls Rescue House in Kenya?
Yeah, thanks so much for having me on. So I reported this story from Kenya, from various parts of the country, looking at how not just COVID, the disease, but COVID-related shutdowns have essentially reversed 25 years of pretty steady progress for girls. You know, what we've seen over the past quarter century is that girls were largely on an upward trajectory. They were staying in school longer, they were getting married and having babies later, they were living healthier and more prosperous lives. And then when COVID hit, and when 350 million children around the world, were out of school, missing their most consistent meal of the day, often stuck at home in abusive situations, what we've seen is that a lot of that progress has been reversed. Even as schools are reopening, a lot of girls are not going back. Some because their parents are unemployed and can't pay the school fees. Many because they have gotten pregnant during the pandemic. So it's a huge and slow-moving disaster, and lots of public health experts and folks who work in the development space are essentially saying that now is the moment that we can act on this, and that if we don't put measures in place to reverse these really disastrous effects for girls, we're going to see the ripple effects not just for this generation, but for generations to come.
Well, and you get into, Jill, this is a story we talked about with Bloomberg Business Week editor Jill Weber for our Bloomberg Business Week weekend show, which airs on the weekend on Bloomberg Radio, and it's also online and on our podcast feed. But what's interesting is that, the pandemic's been going on for a couple of years, and you point out in your story that there's some really significant numbers already showing what has happened. According to aid groups, you write, teen pregnancy rates in some Kenyan countries tripled in the first few months of the pandemic. Early numbers indicating that adolescent maternal deaths and stillbirths increased during that same period. Very easy for us in the developed world to maybe not think so much about teenage pregnancy or potentially losing your life from a pregnancy because we don't have the problems on the same scale that the developing world has. And they really continue to have to deal with that. And it really can set women back in a big way.
Right. And I think one thing to keep in mind is that when we talk about investing in women and girls, that's a really high yield investment. We're not just investing in individuals. When you invest in a girl and a woman, you invest in an entire community. We know that girls who delay marriage and delay childbearing go on to have healthier children. We know that educated women are more likely to raise children who are able to pursue education themselves. We know that women who have higher levels of education and can plan their families are less likely to be stuck in abusive relationships. They're less likely to die in childbirth, and their children are less likely to die at young ages. And so you have all of these downstream ripple effects, and they can be positive ripple effects if we invest in girls. The problem with what we're seeing with COVID's impact on girls and the impact of COVID shutdowns is that many of these positive impacts have been walked back. And we're seeing girls start to have babies earlier, get married earlier, undergo things like female genital cutting. And that impacts, obviously, the opportunities for these girls right now, but also for their children and for the entirety of their communities, and frankly, for the entire economy and well-being of the world.
Well, Jill, you know, Carol mentioned that we spoke about this in our recording for the weekend show, and the point that I brought up is that we hear so much about daily data, cases worldwide, hospitalizations worldwide, deaths worldwide. Those are the direct effects of COVID, but the indirect effects of COVID, I'm wondering how you measure the indirect effects that you write about in your story. What is the data? What are the data that we need to be paying attention to?
Well, so part of the challenge is that because of COVID itself, because it's a contagious respiratory illness, the gold standard for data gathering, which is essentially home visits, so going face-to-face with people, has largely been suspended. And so a lot of data gathering organizations are relying on things like phone interviews. Well, in many parts of the world, the most powerful person in the household, who's usually the father, is the person who has control of the phone, right? So you may not be reaching the most vulnerable members of that household. You probably aren't reaching adolescent girls. So there are huge gaps in the data. The data that we do have shows a pretty dire picture. I know you already mentioned this, but it shows an uptick in adolescent pregnancies, and adolescent pregnancy is the #1 killer of girls in the developing world, of adolescent girls in the developing world. So that's a pretty significant problem. We know that huge numbers of young people have gone hungry. We know that we've seen increased reports of domestic violence, and not just partner violence, but violence in the home, parents abusing children, for example. And we know that many children have not returned to school after they've dropped out. In Kenya, for example, once schools reopened, significantly larger proportions of boys than girls returned to the classroom. So a lot of these girls are just lost. And still, because COVID is an ongoing crisis, we don't fully know just how devastating the impacts are.
You know, reminder that, and Tim and I talk about this a lot, Jill, this idea that this pandemic, you really have to think about your community. It's not necessarily those who live next door to you, your neighborhood, or who you work with, but it's also your global community, right, in terms of getting this under control. Just got about 40 seconds left here. The responsibility of the developed world in helping out. This is important.
It's very important. So, one thing the developed world can do is, as we're funding COVID recovery, to remember that we are all deeply connected. A lesson we really should have learned during a global pandemic. And so making sure that as we are doing a recovery, that it is looking beyond our own borders, and that we're making sure that we invest in girls, in women, in the people that have really borne the largest brunt of this pandemic, not just physically, but also economically and in terms of development.
All right, we're going to leave it on that note. Jill, thank you so much. Really an important read and some great reporting. Jill Filipovich, she is a Bloomberg Businessweek freelance writer. This story is in the new issue of Bloomberg Businessweek magazine. You can get that on newsstands at BloombergBusinessweek.com and also, of course, on the Bloomberg Terminal. And again, catch it in our weekend show.
Yeah, it's a powerful story. It's a heart-wrenching story. Definitely encourage everyone to check it out. Again, available at Bloomberg.com, on the Bloomberg Terminal, and on newsstands.
I feel like we'll be measuring the impact of the pandemic for some time, right?
I mean, look at just schools in the U.S.
Exactly. All right, you're listening to Bloomberg Radio.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. With just 60 minutes left in the trading session, Caroline Hyde, Romaine Bostick, and Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic. We welcome together a full array of Bloomberg audiences, whether you be in TV, radio, YouTube, and the metaverse. We've got to count them too, no matter in which particular environment you are surrounded. It is a day that we reflect, of course, with an anniversary upon our hands, but it's a day that we also do what we do here at Bloomberg, look at the markets and look at them trying to rebound ever so slightly, Carol, but not really.
No, exactly. But I do feel like we're taking a little bit of a breather. And I think reflection is a great way to describe it. Here we are 1 year after January 6th, the Capitol uprisings, if you will. But keep in mind that, a lot happened yesterday. Michael McKee was with us earlier and saying, what the Fed gave us in those minutes, not a lot different from what we heard in the meeting. So it's interesting to see how the market reacted. And maybe we're reassessing that today, Tim.
Okay, so equity's taking a bit of a breather, perhaps save the Russell 2000. You know what's not taking a breather is crypto right now. Bitcoin down 6% in the last 3 days. I'm still trying to figure out what exactly makes Bitcoin move. I know I'm not alone there, but seeing some wild moves in recent days, sending it to levels not seen since September.
Tim, don't front run me, my friend. I've got a good chart on that.
Oh,
Meanwhile,
good.
S&P 500, we're on the same metaverse. Meanwhile, S&P 500 currently up 0.25%. We're seeing volumes up about 17%, so still getting back to action after the holidays. But really, the S&P 500 is still off by more than 1% over the course of the week. We're seeing a little bit of dip buying over in the NASDAQ after a pummeling it got yesterday that was the worst day since February. We're up just 0.3%. That's 43 points higher for our radio audience. We're looking now at the Dow, interestingly, off by 61 points. It had been the outperformer yesterday. Today, your underperformer, off by 0.2%. And the Russell 2000 getting a wiggle on. We're up more than a percentage point in the small caps.
And take a look at where we are in terms of the individual sector level, Caroline. It is pretty unbelievable. Energy again. And how many days have I said this? 4 days of trading session doesn't a trend make? But this has been the theme all year long on these 4 trading sessions. Energy is up 2.4%. It's financials, it's industrials, it's that cyclical reflationary trade driven by that steepening yield curve and yields really rising pretty much all across the board that has it. Down at the bottom, of course, healthcare and utilities, and then, of course, technology, though it is much less negative than it has been, Romaine, in previous sessions.
Yeah, you take a look at some of the individual movers here. Again, we talk about multiples here on this day. The first 2 stocks at the top of the board here for our TV audience, Netflix and Meta platforms, Facebook, moving in opposite directions. Netflix down about 2.5%, a 50+ PE multiple on that stock. Meta platforms up 3% here on the day. One of the more modest PE ratios amongst the cohort of only about 23, 24, at least based on current earnings as well as on a forward basis here. So definitely one of those types of stocks that you can start to look at and say, maybe at least as far as big cap tech goes, this is value. Humana and a lot of the health insurers really taking a massive lay down. Humana shares down 19% right now. This after revising lower its forecast for the year. This is primarily for that Medicare Advantage plan. This is something to really keep an eye on. All the stocks in this space, including United Health and a few others, all moving significantly lower here on the day. Earnings revisions, that's going to be a big story here as we head into the earnings season. And we actually got earnings revisions here out of Lamb Weston, and that was actually to the upside. Big maker of French fries and other frozen food products. Those shares up 9% on the day.
Meanwhile, I go back to where Tim was so expertly directing us, and this is crypto, because you've actually seen a bit of a rebound in the ARK Innovation ETF, for example, a rebound in the IPO ETFs as well, some of the more speculative parts of the market. If you're looking at this particular area of risk-taking, because we're still down. We're, what at 43,000? Remember, this is nowhere near its lows of last year at around 30,000, and that's actually where Mike Novogratz and the like are starting to see the bottom.
You know, what's interesting, too, I don't know if you guys saw this story that passed around 2:15 Wall Street time. Our Vildana Heinrich put it out, but a near record number of tech stocks have plunged by some 50%. This is some research out by the chief research officer at Sundial Capital Research. And basically, at no other point since the bursting of the dot-com bubble have so many companies fallen like this while the index itself was so close to a peak. But what's interesting, too, is go back to March of last year. Remember when we were in a 10% technical correction, and yet we rallied, some 30% from that point. It does feel like today that everybody's kind of reassessing and thinking, okay, maybe there's some names that I could come in and buy, and maybe they're going to wait to see what the rest of the economic points point to in terms of the outlook.
Yeah, well, speaking of those economic points, I mean, I'm looking ahead to tomorrow's jobs report. 444,000 is the number that's estimated. Does that change, guys, how investors think about the strength of the economy, given that it was the first part of December, it's backward looking, but we can still get a read on if it was a strong market for job gains in the last month?
No, I mean, does it change what the Fed is going to do? Does it change the communication that we're hearing out of some of these members, including James Bullard today? No. I mean, as far as I'm concerned, I think the market's eyes right now are on January 26th, where maybe they'll get a little bit more clarity about not only what the Fed's discussing, but let's point out, you talk about that December meeting and the minutes that we got out of there. For the folks who were part of that conversation, of course, we don't know who the hawks were necessarily, but 4 of those folks aren't voting members right now here in 2022. You got 4 new members coming in, and so you wonder if that conversation changes for the better or for the worse come January 26th when they meet again.
And let's talk about that conversation coming from the Federal Reserve, because Bullard is indeed speaking, saying in December he penciled in 3 2022 rate hikes, and if inflation moderates, that could slow in the second half in terms of overall hikes he sees. But his own view is to start the runoff shortly after a rate hike. It was that runoff, it was that talk about the balance sheet, Taylor, that really seemed to sort of wrong foot some market participants.
Indeed, yesterday we got that, though. Ellen Zentner was front and center on that, releasing a note before those meeting minutes saying she wanted guidance on that balance sheet runoff. We're also getting some clarity, Caroline, about the jobs market as well, with Bullard saying that pre-pandemic jobs levels isn't a good benchmark, that maybe something more structural has shifted, as everyone has been saying, okay, well, we need to tackle inflation, but maybe the jobs market isn't where it needs to be. So saying that pre-pandemic jobs levels, not a good benchmark anymore to be using.
I think what's also interesting about Bullard, and we should remember that he's often seen as a bellwether for the Federal Reserve. What's also interesting, though, is he's optimistic about growth in the United States. And I think that is something that we've heard from a lot of individuals. And again, Romaine, can we look through the pandemic? Can we look through some data points that might be a little bit questionable? And can we think about what's going to be the growth environment and what does that mean for Fed movements?
Yeah, and I think, I don't think anyone questions whether there's going to be growth. I think what they're questioning right now is whether the Fed gets in the way of that growth. And I mean, how do you fight inflation without completely curtailing some of the gains that a lot of people have priced into this market with regards to the economic picture?
Right, a policy misstep is what, if you will. All right, folks, that's going to do it for now. We'll be back at 4 p.m. Wall Street time for Beyond the Bell, our cross-platform coverage on radio, TV, and YouTube. We're going to take you through the market close on this Thursday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And you're listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic. So some Bullard comments.
Yes.
What's interesting is...
I want to go there, Carol, with
Why?
you.
Go.
I want to go there with you. Okay,
Go.
Bullard says that the pre-pandemic jobs level isn't a good benchmark. I think to myself, okay, this is what I've been hearing from Carol Masser for the last year. What is a good benchmark for us to use? What should we use to understand if we're at full employment and if we're recovered from a jobs perspective?
I don't know. I mean, I'm not. This is what we're going to have to figure out, and I guess we'll have to look at things like economic growth and our CEOs saying that they have all the jobs filled that they need. Like, I don't know. I mean, I think
they're not saying that.
They're not even close to that. So it's going to be kind of tricky because we have certainly had these conversations that people are rethinking about maybe how they work, where they work, do they work, do a 2-income family now say we're going to make do on 1 income and live differently?
We talk to a lot of observers who say you have to throw out the playbook because this is sort of unprecedented.
And where we should be on jobs and labor participation.
Where?
Well, what does that mean?
That's the question.
But that means what? Where we should be at this point in the cycle.
Or does it mean we're recovered or we're in a recovery that's on pace?
I don't know. I don't know that I'd read it that way. I think it's in a recovery cycle to some extent. And this is where we'll look for some clarification, right?
We're getting a bit of an idea of how investors parse comments from Fed officials, right?
Yeah, and it does definitely feel like in terms of today's investment environment, we're taking a bit of a breather. It was big moves yesterday, a continuation of a move up in terms of the Treasury market, and certainly in those yields and some pressure on the equity market. But the equity market has had a big run in the last couple of years, to say the least.
Let's head to Washington, D.C. now for a check of the latest world and national news. Nancy Lyons is standing by in D.C. Hey, Nance.
Hey, Tim. President Biden today commemorated the one-year anniversary of the attack on the U.S. Capitol by warning democracy remains at risk as the memory of that day lingers.
We saw with our own eyes rioters menace these halls, threatening the life of the Speaker of the House, literally erecting gallows to hang the Vice President of the United States of America.
Biden blamed Donald Trump for the attack, calling him out not by name but by title, former president. Biden said for the first time in the nation's history, a president not just lost an election, but tried to prevent the peaceful transfer of power. As the violent mob breached the Capitol, he says it was the former president who rallied the mob to attack while he sat in a private dining room off the Oval Office, watching it all on television and doing nothing. Republican reaction to President Biden's speech is as mixed as the divide within the party over former President Trump's role going forward.
Longtime GOP strategist Karl Rove wrote a piece in the Wall Street Journal asking Republicans how they'd react if Democrats had attacked the Capitol claiming fraud after Trump's win in 2016. Rove says there can be no soft-pedaling January 6th. Republican Senator Lindsey Graham reacted on Twitter, accusing President Biden of, quote, brazen politicization of January 6th. And former President Donald Trump himself put out a series of statements accusing the president of using his name to further divide the country. President Biden did not say the words Donald Trump in his speech. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. You are listening to Bloomberg Business Week. Carol Master along with Tim Stenovic. And we were just referencing some comments by Jim Bullard. He is the president of the St. Louis Fed. He is often seen as a bellwether for the Federal Reserve in terms of what he says. He is a voting member this year, and he's one of the more hawkish members. He had some prepared comments at an event in St. Louis, and he's obviously making those comments as well.
So here's what we're watching. He says, quote, the FOMC could begin increasing the policy rate as early as the March meeting in order to be in a better position to control inflation. Subsequent rate increases during 2022 could be pulled forward or pushed back depending on inflation developments. So depending on whether inflation goes higher or if it's softer than expected.
There's always a lot of coulda, woulda, shoulda, careful, be careful, you know, like
data
it's funny.
Dependent, Carol.
Well, exactly. And he said you need to be prepared in case prices don't ease as hoped. You know, balance sheet could return to pre-virus level over years. It's interesting. Peter Bookvar, who follows the markets and put out a note earlier too, and he said, voting member Jim Bullard is saying today that the first rate hike could come in March, and with respect to the balance sheet, the FOMC could also elect to allow passive balance sheet runoff in order to reduce monetary accommodation at an appropriate pace. He's over at Bleakley Advisory, and he said could is the key word here because this whole conversation just depends. And he goes, I'll argue that QT is not going to become a realistic conversation until after the Fed has a few rate hikes under their belt, which won't be until at least late spring, early summer. Remember, too, when the Fed does something, there's a lag time. And so, you know, if you're dealing with interest rates and balance sheet moves and runoffs and not doing asset purchases, like all of this could be a multiplier effect in terms of how it impacts the economy, and we won't know the impact for months to come.
That is a really good point. I do want to also fit in, Carol, that we're hearing from other members of the Fed. Bullard's comments were more hawkish than those of San Francisco Fed President Mary Daly, who in a separate event said that she favored the acceleration of tapering but gave no opinion on shrinking the balance sheet afterwards. That's a very different conversation than reducing our balance sheet, she said.
Yeah, absolutely. All right, folks, you're listening to Bloomberg Business Week. I'm Carol Master along with Tim Stenovic, and this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We're looking at a mixed Thursday here. The Dow lower, S&P, NASDAQ, both higher. NASDAQ coming roaring back from where it was. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are mixed, but trading off their session lows. Dow's currently down 105 points. S&Ps are higher by 7, and NASDAQ originally lower, now higher by 35. The U.S. 10-year yield at 1.73%. Gold is down 21, and Bitcoin is little changed. Among the main 11 S&P sectors, leaders were energy and the financials. Materials and healthcare were under pressure, and leaders to the upside in the Dow, Travelers and Salesforce, while UNH and IBM led to the downside. After earnings, Lamb Weston surged as much as 13%, and in other news, Rivian plunged as much as 16%, and it fell below the $78 a share price IPO intraday. Also, Humana plunged after cutting its Medicare outlook. In deal news, Stryker to buy Vocera Communications for $79.25 a share. And wrapping things up, WD-40 reports after the bell. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg time, Squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. So, Tim, if you're under 40, you've never seen a hawkish Fed.
Okay, president company included, me, right?
Exactly. And this is what our macro man, Cameron Krise, writes about in his column today. This story, by the way, among our most read on the Bloomberg terminal.
Cameron is macro strategist for Bloomberg News. He joins us on the phone from Connecticut. You can follow him on Twitter, by the way, at Fifth Rule. Hey, Cameron, I got a question for you.
Sure.
When was the last time that the Federal Reserve exhibited a quote strong commitment to address elevated inflation pressures?
Well, that's the question, right?
Yeah.
I think you can pretty much argue it was the 1990s. I like to think of tightening cycles in two broad categories. One is a central bank that's hiking because it quote unquote wants to, i.e., it wants to adjust the level of rates almost in a preemptive fashion. And then there's the central bank that tighten because they have to, which is because inflation is becoming an issue. And I certainly think that if you look back to the 2004-2006 cycle, and then the most recent one from the end of 2015, 2016 through the end of 2018, both of those were cycles in which the Fed hiked because they wanted to. And the characteristics of that sort of cycle is that they can guide exactly what they're going to do. They move very deliberately, 25 basis points a move. They're not trying to shock anybody. They don't want to upset the apple cart. If you go back to the 1990s, say the 1994 cycle, they hiked very, very aggressively with several moves of 50 basis points or more, and that sent shockwaves through the bond market. Even the cycle in 1999-2000 ended with a 50 basis point hike. If you were 40, really, if you're 45 or below, you've never seen the Fed hike by more than 25 basis points.
So, I was thinking about your column when you were thinking about how to address the FOMC minutes yesterday, Cameron, and the subsequent market reaction. Why did you write this particular column today?
Well, I think it's a combination of a few things. One is that they deliberately, there was a cohort of the committee that deliberately, said that they wanted to show the market a strong commitment to combating inflation, and that's something that hasn't been evident, literally in decades. And the second, I think, is sort of the starting point that we're coming from, which is real yields are extraordinarily low, whether you look at nominal treasury yields versus spot inflation, or if you look at TIPS yields, which are more of a forward-looking measure of real interest rates.
And you have a great, can I just point out it's obviously this isn't going to play so well on radio, but you can go to the Bloomberg terminal, Bloomberg.com, but you have a great chart in your story that gives us some perspective on yields, right? Real yields, where we are today versus where we were 20 years ago.
Yeah, we've moved up 35 basis points over the last week or so in 10-year real yields, which is a pretty big move. We've gone from like minus 111 to minus 77. That's a big move. But if you look at the chart, it doesn't even touch the sides. It's minuscule. And I think you can argue more, which is more relevant to your average listener, your average investor, is that those extremely negative real interest rates are sort of the foundation for what you might term excessive valuations, particularly in riskier areas of the market. The speculative stocks that make no money, crypto, the meme stocks, what have you. And so I think the natural implication is if and as the Fed does execute a legitimately hawkish policy cycle, and in fairness, the jury remains out on that. We'll see how things evolve. But if that happens, we could see a very significant move higher in real interest rates, and those being the foundation of pricing across the risky asset spectrum could really send, I think, a few shockwaves into some of these assets. And we're already seeing it, certainly, in some of the more speculative areas of the market.
So, for example, the NASDAQ composite it's higher today, but just by 0.1%. Do you think that message, that was the message that tech got yesterday, but it's somehow not getting it today? I mean, help make the connection beyond just a one day of volatility when it comes to those high-flying tech names.
Yeah, I think absolutely. It's not just yesterday. This week, you've seen tech underperform small caps. You've seen growth underperform value. Those are sort of the classic indications of sort of perceived policy tightening, because these extraordinarily expensive stocks, tech generally, if you will, the meme stocks, the innovation stocks, whatever you want to call them, a little more specifically, they're priced, kind of discounting earnings into the infinite future, today, giving them a very high value today. And obviously, the higher the interest rates go, the more of a discount factor that you have to apply, and the lower the current present value is of those earnings into the distant future.
Yeah, exactly. And it certainly explains some of the pressure that we've seen, particularly on some of those higher valued companies. Hey, Cameron, thanks so much. Cameron Kreis, macro strategist at Bloomberg News, joining us on the phone in Connecticut. We've got just about 36 minutes left in today's trading session. Yeah. Is that it? And we're definitely off our lows when it comes to the equity markets. We've been bouncing around a lot, so a fair amount of volatility. And in terms of yields, kind of hovering near those levels that we hit upon in yesterday's trade. So right now, that 10-year note at about 1.72. You're listening to Bloomberg Business Week. Carol Master, Tim Stanovic. Coming up, the chart of the day on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. And coming up, we're going to get to the chart of the day.
Yeah, Kriti Gupta, Bloomberg Markets correspondent, is going to join us. Her chart of the day, the bull bear case for oil, but she's looking at bonds. We'll have her explain.
We will indeed. All right, we'll get to that in just a moment. She's also got something interesting that has caught her eye. First up, though, let's get back to Charlie Pellet. Hey, Charlie.
Well, hello there. We've got 28 minutes to go ahead of the closing bell. Let's begin with crude oil up 2.3% right now, 79.67, higher by $1.82 a barrel. 10-year down 6/30 seconds. 10-year yield right now 1.72%. Wild day for the equity market. At one point, we had NASDAQ down 203, down by about 0.6%. Right now, with 28 minutes to go, we have got NASDAQ higher by 22 points, up by about 0.1%. S&P, though, swinging between gains and losses after the biggest rout since November. Investors reassessing valuations amid the Federal Reserve's latest signal that it will move aggressively to tamp down inflation. S&P up 1 point, little change there. The Dow does remain lower by 143 points, down 0.4%. Again, the 10-year 1.72%. Spot gold down 1.2%, 17.89 the ounce, and Bitcoin now lower by 0.9%, 43,206 on Bitcoin. It is tough to find home testing kits, and when you do find them, they can be pricey. Digital marketplaces like are listing Binax Now kits, which include 2 tests for as high as $75, around 3 times what they cost at many large retailers. Dr. Chris Byrer is a professor of epidemiology at the Johns Hopkins Bloomberg School of Public Health. He sees the tight supply eventually easing, but certainly not for a couple of weeks.
The estimate is roughly that by the 3rd or 4th week of January, we should be coming out of this testing shortage, but that again is not going to be in time to deal with the post-holiday waves of infection that we're seeing. So we're going to have about 2 weeks where people are still going to be frustrated we won't have enough tests.
Dr. Byrer with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks, mixed picture. Pfizer down 1.1%. Its German partner BioNTech, its ADRs up 1.6%. AstraZeneca's ADRs down 0.1%. Moderna shares up by 1.5%. Johnson & Johnson down by 0.2%. Recapping, 10-year yield 1.72%. S&P up now by 0.5 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Well, joining us now, as she does each and every day at this time, is Kriti Gupta, Bloomberg Markets correspondent for Bloomberg News. She joins us not only with her chart of the day, but a story that's caught her eye. Let's get to her chart of the day first, though, because it's about the bull bear case for oil, but it's explained with bonds. So go ahead and give us, tell us how this works, Kriti.
Yeah, absolutely. So we're all talking about the Fed, right, and how they're trying to hike essentially more aggressively, perhaps exploring some quantitative tightening. And we should talk about what the ripple effect is, not just in the bond market, but into the stock market and into the commodities market. We saw the stock market sell off pretty furiously yesterday, but the commodity market actually ended up higher, which is kind of a weird thing to think about when you're talking about risk assets kind of being spooked by the Fed, because at the end of the day, commodities like oil, like metals, even food are at the end of the day risk assets. So my chart of the day looks at the 40-day correlation between 10-year yields and the Bloomberg Commodity Index. And basically what you're seeing is that they're actually very highly correlated. They are very strong correlated, which means when yields go up, the commodity complex does as well. And when yields go down, so do commodities. And the reason for this is because as you start to see inflation pressures and expectations that the Fed is going to act kind of ratchet up yields, well, let's talk about where the inflation is coming from to begin with. It's coming from oil, from metals, from food prices, and that's something that actually serves as an inflation hedge in your portfolio. And so that's going to be your bull case there, but I want to also highlight the bear case for oil, which of course comes back to real yields. At the end of the day, yes, you have a 10-year yield that is rising and rising, but real yields, really accounting for the inflation that continues to rise, well, they're still negative. When you see real yields, however, turn positive, that might actually eat into some of the risk appetite for things like stocks, for things like commodities. So that's going to be the bear case of where oil might be going.
So you just debated yourself, right?
I did. I gave you the bull and the bear case.
That's smart.
For our audience to make up their mind.
Yeah, and you know what's kind of fun about that is that we are at this point where you can make the arguments for a lot of different scenarios, it feels like. And this is why, we joke, but, we talked about earlier being data dependent. I mean, it really is what's the trend lines? What kind of case do they ultimately build or point towards in the next few months? And we'll see if we start to get some definition, because we're seeing some volatility certainly in the financial markets this year, and you just do wonder, what comes next.
You're not the only one.
No, we all do, right?
Yeah. I'm trying to figure out ways to explain breadth and, stocks that are above their moving averages and below their moving averages, because
you've been making some charts and some
working
on the Bloomberg over there.
Well, look, I think I bring it back to equities, but and Creedy, jump in here wherever you want. But we've heard over and over again in recent weeks from our stock picker guests that this is a year for stock pickers. And if we
so says the stock picker.
Exactly, that's what I'm saying. And look, and last year wasn't a year for hedge funds. But if we are seeing indeed this rise in yields cause a concern among those highly valued names, then maybe it is.
Yeah, I think it's a good point. I mean, the stock market gets really tricky because there are so many other factors impacting the stock market. They have to take their cue from growth, from commodities, from currency exposure, even from the bond market and what the Fed is doing. The bond market is a little bit more straightforward in the fact that it's kind of very anchored to what the Fed's doing. Commodity is very straightforward in the fact that you are actually pricing in exactly the raw materials that people need. But to your point, I mean, that's also the consensus. I also hear that it's a stock picker's year, and based on the tech sell-off that you're seeing, it's a totally fair argument to make.
Yeah. We're just still early in on the game. I'm just going to say here in 2022. Hey, listen, you something that caught my attention this morning too. And this is a reminder when we think about concerns. Sometimes they're not the ones that are front and center on our radar. You talk about a story, or you saw a story about Russia in particular and some of what's going on there. There's been an unrest.
There has been unrest in Kazakhstan, which is bordering Russia. Essentially one of the major uranium makers of the world. Now, I'm not going to dive into uranium. Don't worry, guys. I am going to dive into what's causing these protests. And it's essentially the fact that the government doubled the cost of fuel prices. They're actually seeing inflation much, much higher. Consumer prices rising 8.7% in a country where their central bank target is just 6%. So I kind of giving you the broad takeaway here is that there are parts of the world where inflation is rising much, much faster than you're seeing in the United States or even in Europe. And their response to it is through these protests.
Dozens of anti-government protesters killed by security forces there. All right, Creedy, thank you so much. Creedy Gupta at Bloomberg News.
Okay, get Creedy's chart of the day at Twitter and Instagram, and at Creedy Gupta 129 at Bloomberg.net. Now to Nancy Lyons for a news update. Hey, Nance.
Thanks, Tim. President Biden spoke from Statuary Hall in the U.S. Capitol today, a year after the insurrection, and had harsh words for former President Donald Trump and his supporters. He says it's time for Americans to embrace the truth and realize our democracy is at risk.
On this day of remembrance, we must make sure that such attack never happens again.
Both houses of Congress observed a moment of silence in memory of the police officers who died from the mob invasion.
Speaker Nancy Pelosi addressed a brief session of the House.
The insurrection sought not only to attack the building, but to undermine democracy itself.
Senate Majority Leader Chuck Schumer.
Donald Trump today continues to spread his poisonous vial, the big lie. The violent insurrection of January 6th was the final, bitter, unforgivable act of the worst president in modern times.
Republican leaders were in Georgia for the funeral of the late Senator Johnny Isakson. In Washington, Irv Chapman, Bloomberg Radio.
The focus in Washington is likely to snap right back to the pandemic tomorrow. That's when the Supreme Court hears emergency arguments over President Biden's vaccine mandates. Bloomberg Government's Emily Wilkins reports 2 administration rules are in play.
One is requiring that companies with more than 100 workers require those workers to get vaccinated or regularly tested. And the second one requires workers for facilities receiving government health care funding to make sure that they are vaccinated.
Emily Wilkins reports The conservative majority court has already blocked one administration effort to contain the virus. It lifted the CDC's eviction moratorium last August. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons there in our 99.1 newsroom in the nation's capital. Carol Masser and Tim Stanovic, we're at Bloomberg headquarters in New York. We're awaiting some snow, not yet. Perhaps in the morning, you and I were like...
just in time for the commute.
But you and I were saying, every time they're going to say, oh, it's snow, it's snow. And we like wake up and there's like a drizzle. It's like, or it's raining.
You wake up in a hotel because you don't want to go home because you don't want to get stuck, right? And then it turns out you don't need to. Hey, we're talking about Bitcoin though.
Let's do it.
Certainly something that I've been keeping my eye on in these last couple of days. There have been a lot of calls for Bitcoin that it could hit $100,000. Those calls came last year and they're still coming. The largest cryptocurrency by market value. It shed, though, about $80 billion since the start of the year amid a slump that's brought to its lowest level since early December flash crash. Well, now to early September. But out have come predictions that it can still reach the vaunted $100,000 level, at least at some point this year.
Earlier this week, Goldman Sachs analyst Zach Pandal writing that Bitcoin could hit that $100,000 mark if it continues to take market share from gold specifically. I'm just looking from that November 9th high. We're down about 36% on Bitcoin specifically. So we've definitely seen a pullback. It would have to more than double then from current levels. Around 42,900 is where we are. Actually, we're above 43, I guess, to arrive at that milestone. We've seen tremendous moves. I mean, volatility equals cryptocurrencies and Bitcoin in particular. So
yeah,
to rule it out completely would be kind of foolish on our part.
Well, look, we had Mike McGlone on Quick Take Stock earlier in the day. We spent a good portion of the beginning of the show focused on cryptocurrency. Mike continues to say that Bitcoin is replacing gold. He's a commodity strategist, so he's been doing this for years. He says that it will replace gold. He does say that it's heading toward $100,000. That's in a note that he put out recently. He said cryptos are tops among the risky and speculative. If risk assets decline, it helps the Fed's inflation fight, but as it becomes a global reserve asset, it may be a primary beneficiary in that scenario.
You mentioned the Fed, and you do wonder if the road ahead for crypto is going to be much more difficult with a more hawkish Fed and not so much liquidity out there. How much of that was the reason why we saw such a run-up initially? Stay tuned for that, everyone. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. We've got the Dow, the S&P, NASDAQ, all lower. Stocks declining across the board now. Had been swinging between gains and losses, but right now red on the screen. This after the biggest rout since November. Investors continue to reassess valuations amid the Fed's latest signal that it will move aggressively to tamp down inflation. At one point, we did have NASDAQ down 185 points, down 1.2%. NASDAQ Composite Index now down 21, a drop there of 0.1%. The NASDAQ 100 Index also down 0.1%. S&P 500 Index lower, little change, down 3 points now, down 0.1%. The Dow has been lower all day, down now by 165 points, down by 0.5%. 10-year down 5/30 seconds. 10-year yield now 1.72%. Gold down $21 the ounce at $17.88, drop there of 1.2%. Bitcoin moving lower by 0.9%, 43,227 on Bitcoin. Crude rallying 2.1%, 79.49 a barrel. So again, recapping, 10-year yield 1.72%. S&P down 3 now, a drop of just about 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
In the years since the January 6th attack on the U.S. Capitol, the government has responded better than might have been expected. Law enforcement agencies have charged at least 700 participants. Congressional investigators have interviewed hundreds of witnesses. And federal courts have resisted efforts by former President Donald Trump to deny Congress access to documents and testimony. Such progress shows the resilience of America's democratic institutions. It also underscores the need for the House Select Committee investigating the attack to quickly complete its inquiry. Its chair, Representative Benny Thompson, has said the panel only plans to release interim findings by the summer. That risks extending the probe deep into 2022. The committee should instead complete its work and issue an unredacted public report well ahead of the November midterm elections. The rest will be up to the voters. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10 minutes left in today's trading session, and it's been an interesting week already here in 2022. Still got another day to go. We've got that monthly jobs report. Let's get to it. The Drive to the Close. Alan Zaffron, founding partner and co-CEO at IAQ Capital, with us once again on the phone from Foster City, California. First of all, Alan, Happy New Year from Tim and me. How are you?
Hey, I'm doing great, Carol. Happy New Year to you. And I can tell you, thankfully, the building isn't shaking like it was last time.
Oh, yeah, that's right. You had that small earthquake last time you were on the phone with us.
Although the markets are shaking, so that's what's shaking right now. So doing great. Actually, I know this will sound terrible. Nice to see a little turbulence and weakness, which if you happen to have, a constructive longer-term view, this is the time to step in and increase or consider maintaining, if not increasing, your equity exposure. So, you get spooked by this, but
buying opportunity.
This is the time though where we're only down 3% on the NASDAQ year to date. Are you going to expect more buying opportunities in the coming weeks and coming months?
You never know for sure, and of course in the stock pickers market as well. Some of these stocks, particularly the stocks that aren't earning anything anytime soon, are interest rate sensitive, are down far more than 3%.
Of course.
If I were a long-term investor, I would be beginning to dollar cost average and being a buyer here. If I held stock exposure already, I would not be in a panic. I would be looking for eventually a way to increase my exposure, particularly to U.S. equities and particularly to growth-oriented U.S.-centric businesses, because once we get through the stimulus of the pandemic and our economic growth decelerates, we are going to get back to the world that looked like before 2019 and 20, which was a slow, grinding economy, which was why these large cap tech companies that grew despite slow economic global growth still did quite well. So that is selectively where you still want to be looking if you're looking at equities.
It's interesting that you say that, Alan, because certainly a big part of the conversation has been what the $1 trillion tech rout that we've seen in so many names here in this first week of the new year. And so names that have been driving, especially those big tech names, you know who they are. This is an opportunity to maybe get in at a lower valuation?
I think so. Again, nibbling on that. Everyone's going to say, oh, that's Alan from Silicon Valley talking his book. But no. What that is...
Well, where have you added? Where have you, or where did you tell people to add, let's say, in the last 24 hours?
People coming were saying, don't panic. Right, we think this year U.S. equities will once again do better than non-U.S. equities, both emerging market and international non-U.S. developed markets.
Because of better growth? Because of better growth?
Yes. In fact, you're going to get me to punchline a different way. We think Europe is going to be very weak economically, could even go into a recession, and China is struggling to grow economically. That actually will be forces to keep long-term interest rates down. I think this rise we're seeing in yields is to a degree a head fake. I'll be surprised if at the end of the year the 10-year is as high as it is today at 1.75%.
Really?
Therefore, I am willing to buy large growth stocks. Now, I still would rather be in companies that really generate earnings. I hate to say this to many companies that have recently gone public because they are far more sensitive to interest rates, and if that outlook is wrong, they will get hurt further. But your safe play. I'm
guessing you're not buying Rivian then. You're not buying Rivian, maybe.
No. That was not what I would recommend because obviously the earnings aren't the value. Trying to derive a valuation model when a company doesn't have earnings is incredibly complicated. And again, the valuation is based on a discounted cash flow model, and the higher the interest rate, the less the value of the dollars 5, 8, 10 years from now. And therefore, the company isn't worth as much in my model, and that's why I sell that stock. If I'm buying the large cap quality names, they're generating earnings. I can figure out a multiple on pay.
Yeah.
Because I know we're going to have you back on later this year, several times before the end of the year. Give me that where you think that the yield on the 10-year is going to be by the end of the year.
I think it's going to be around 1.5%. Look, there's two different things going on with interest rates. First of all, we have all those long-term secular things. We had slow growth. We had aging populations in the developed countries, which is Europe, Japan, and the U.S. You have globalization, which is still around. You have tremendous technological progress pushing down prices. Those are the secular forces. On top of that, growth is going to decelerate as we go through the year. And most importantly, there's a tremendous correlation between what happens with the German bond market and the U.S. bond market. It's a global bond market. And when Japanese 10-year bonds yielding nothing and German bonds are yielding negative, people roll into the U.S. Treasury market. So I am not fearful that we're in a wage spiral inflation that's going to decimate the bull market. It's not over.
So there is no alternative, basically, to the U.S. Having said that, in your history of investing, have there been times where you have aggressively been overweight, either your exposure to Asia or to Europe, or is the U.S. really always kind of a guiding light within your portfolio management?
No, it's in the 90s, you go back a long way. It was the era of consumption, particularly in China, and it was emerging markets in the 1990s were roaring. So there were times, but in the last decade, U.S. preeminence in equities has been very clear. And there's no evidence that that should change anytime soon, particularly because most countries have very significant problems with their balance sheets, the governments at least. And the U.S. is a more stabilized place in which to invest. So emerging markets haven't yet stabilized to the point that putting tremendous amounts of capital makes a lot of sense.
Hey, Alan, we only have 20 seconds left with you, but when do you think we're going to get to that point what the world looked before 2020? Like, when are we past the Omicron? When are we looking past the virus?
I just got about 20 seconds.
We're past Omicron in 3 months or less. There may be another variant coming. Masks are going to be worn for the next 2 to 3 years, but God willing, Omicron is evidence that the variants are actually getting less virulent, and hopefully that mitigates further hospitalizations and deaths. So the world will slowly evolve back to something like it looked, although masks will probably be worn for a few more years.
All right. Well, still optimistic and still liking the United States, and especially when it comes to those large U.S. growth names. Hey, Alan, Happy New Year. Nice to check in with you. Alan Safran, founding partner and co-CEO at IEQ Capital, on the phone from Foster City, California. Good to check in with him, and do stay safe. Having said that, just a few minutes left in today's trading session. We are bouncing around a lot, so we're seeing a fair amount of volatility in the trade, but we are down across the board, and we're going to count you down to the closing bell. In fact, we're going to head over to our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs, counting you down to the closing bell, here to help take us beyond the bell. Our global simulcast, Carol Massar and Tim Stenovic, bringing together all of our audiences across Bloomberg Television, radio, as well as on YouTube. And Carol, this was kind of the day where you saw the dip buyers sort of make an attempt to come back in here, but it just wasn't broad-based enough to really hold some of those gains into the close.
No, it's a good point, Romaine, and that's why you're seeing some bouncing around here. We've certainly seen it throughout the session. One name and one sector, I should say, that is really standing out is those U.S. bank stocks, and they are set for a record high today. So we've seen a big move up when it comes to the KBW. So we'll see how that tracks into the close, Tim.
Yeah, interesting that you mentioned those dip buyers, Romaine, because we just spoke to Alan Zafran, founding partner and co-CEO at IEQ Capital. He said a really good opportunity right now because of those high-flying tech stocks, that many of which are below and 50% off recent highs, starting to come in and start to scoop them up. He's optimistic that this is a good buying opportunity when you look at it below the surface, below the index level.
Yeah, meanwhile, I don't know about you, bracing for snow in the east coast of New York.
Yeah.
It's clearly coming over the evening, and that's getting a bid for oil. Oil continuing to rise higher, and the supply side issues we've got there too. Notable, some of those oil companies really outperforming once again today.
When is it supposed to snow?
Tonight.
I missed this.
About midnight or
Get
so.
home.
Did
Don't
you
go
really
back
miss
out
this?
again. It starts tonight.
I'm a trooper, Taylor.
Delta already canceling flights, so we'll definitely see some impact on certainly the travel
Well,
side.
something to keep an eye on, and I do want to go back to the financials. You talk about the financials being at a record high, whether it's S&P Financials, KBW Bank Index, or even the regional bank index here. I mean, all of these stocks moving higher, and we do get the earnings out of them next week. At least it starts next week with the big banks, and we'll talk about that in just a moment. Though, I want to recap where we're getting right now. Of course, with the closing bells here in New York, we had been in the green on all the major indices at one point on the day, but it looks like we're going to close lower here on the Dow Jones Industrial Average by about 0.5%, the S&P 500 by about 0.1%, and the NASDAQ Composite also by about 0.1%. The one bright spot that we're seeing out there is the Russell 2000. It's going to finish the day higher by about 0.6%, and a lot of that, guys, is because of what we were just talking about, financials and energy stocks. They're putting a bid under those small cap names in the Russell 2000. I don't know if we could show it, but the Russell 2000 getting that bid today primarily because of those names.
Yeah, the KBW Bank Index. Let's go to that one. We've been talking about it, Romaine. You highlighting those financials up 3.25%. So we're closing here at a record, guys. So we're definitely seeing that play out here in terms of one of the sectors and groups that we're watching.
I was liking
Taylor.
the professional bull riders. Can I just say they were ringing the bell today?
I did not.
Did you see all those cowboy hats?
Yes.
Did not see that.
We watch that every day. You're not a professional bull rider person? You seem shocked by that.
Let's get back on track with these markets. Take a look at where we are in terms of the sector level for the S&P and Romania and Carol, really to your point, really interesting that 4 days has sort of been the trend that we've really been seeing all year, and this trend continues to it's energy and it's banks. That is what's the best performer today. You're up about 2.5% on both of those. And otherwise, you're also getting some media and some food and beverage in there as well. Down at the bottom of the screen, though, you could talk about an unwind in technology with tech hardware and equipment and services index. Those are some of the worst performers. You're off about 1 to 2.3%, Carol.
All right, let's get to some specific gainers for the Thursday trade. This is a name I don't talk about a lot, but maybe we should. Lamb Weston Holdings. This was your number 2 gainer in the S&P 500 today. It's a packaged food company. They came out with their second quarter results.
It's not a packaged food company. It's a French fry company.
Isn't that packaged food?
No.
Okay.
It's French fries.
Okay. It's
He's
French fries.
nitpicking.
It's French fries. I'm going to nitpick you all day.
You're a little cranky. What side of the bed did you get up on today? I'm just going to say.
He was doing
the French fry side.
He was being really funny yesterday, and he's saved up all his wit.
I know. All right. Well, LW is the ticker. Stock up 7.4%. Jeffrey's too out with some positive comments. Let's get to the New York Times Company. A little bit of deal flow. I love tracking that. And according to a person familiar, it looks like they're going to buy the Athletic Sports News website for about $550 million. So that stock, New York Times up 4.7%. And Peloton Interactive, often among Tim's decliner list, different tone in today's session, up about 5%. Top of the NASDAQ 100, still down about 76% in the past year. Maybe people were just like saying enough is enough already. And JP Morgan, I don't know if you saw this yesterday, coming out, the analyst there, slashing his price target by $30 to 50 from 70 and still being a bull on it. How does that work? Do you understand that? I don't know. Tim, do you understand that?
I don't, but I think maybe you're right. I mean, it did hit a 52-week low yesterday, I believe. So off of those lows. Hey, let's talk about some of those decliners. Starting with Humana, finishing the day down by, more than 19%, closing lower in its biggest decline since 2009. Company reaffirming its earnings per share, but cutting its forecast for Medicare membership growth by about half, causing other insurers to go lower as well. Netflix finished the day down by 2.5%, down for a fifth day in the row. We're still seeing some pressure on those tech stocks. We did see Scott Devitt at Stifel note that several near-term concerns could be weighing on shares at the same time, weakening app engagement starting in November, increasing investor focus on new streaming competition, and then concerns over less profitable growth in international markets. Rivian, it was down earlier in the day as much as 16%, but finished the day down by 3%. It did fall below its November IPO price. Growing competition in the EV market down for a second day in a row. Yesterday, it finished lower by more than 11% after Amazon announced a deal with Stellantis. But then Deutsche Bank coming out today and saying that, look, Amazon's a very large company, and it's going to need multiple EV suppliers. We can't forget, too, that Amazon has, an 18% stake in Rivian.
Yeah, this seems so overblown.
Does it?
Well, they got no cars to deliver right now. Of course, Amazon's getting vans from another company, but that doesn't mean that their relationship with Rivian is somehow soured.
And I also think part of yesterday's decline, Romaine, had to do with, just what we saw across the board with huge tech names, right?
I think we should all get some French fries.
Is that packaged?
We should.
Packaged fries or not?
Food prices,
I don't know.
The food price is still going up. And then I don't have the price of
prices doing,
potatoes, but milk is actually down on the day, Romaine, by a whopping 3.3%. Don't ask me why, I'm not entirely sure, but I'll get you the memo. Meanwhile, WTI crude, if you look across the other commodities, up 2%. As we know, there's a cold snap, Canada, US, some of the oil flow is going to be an issue there. Even as we see on the demand side, some worries about, of course, the ongoing COVID crisis. What does that mean in terms of demand coming from China? Brent crude up 1.4%, $81.96 is where we trade. So oil had a good day. Metals, not so much. Copper perhaps on the downside as we worried about what the Federal Reserve and increase, a pullback on monetary stimulus will mean for some of the demands on metals. That's perhaps why we saw some of the FX-related pairs on the downside. Aussie dollar off by 0.8%. We saw also, though, Kiwi off by 0.8%. Maybe that's affected by milk because they're a big player there. Though this is a story of weakness versus the US dollar. The US dollar gets a bid. Why? Because yields are going higher here in the United States, but I will not steal Taylor's thunder. Instead, I look across the world. This was a global bond rout today. Gilts, 30-year, up 7 basis points. Canadian 30-year, up 7 basis points. Belgian, Europe, we saw overall money moving out of global bonds.
Yes, indeed you do. At least here on the short end as well, Caroline. You're really seeing, again, yields rising on the 2s and the 5s. I mean, I would note that we started at 1.70 basis points. We're now at 88 basis points. So in a matter of 2 weeks, Carol, we've really sort of readjusted where we are, but we finally get some stability, at least out on the long end. On the 20s and 30s, mostly unchanged on the day. So really it's the short end of that market I think that we're looking at as we're also pushing forward. I noted jobs day tomorrow and thinking about how this full employment picture really looks and what that means for a Federal Reserve.
All right. Yeah, and we tend to see this, right, in the Treasury trade, that you see a seeking of some new levels and then kind of a leveling out. In the meantime, Romaine, are you a crinkle cut, a steak fries kind of guy? I've been now lost on the website.
No, fries are awful. Crinkle cut is just kind of a sham. Just, the nice thin ones, like the ones McDonald's has. That's the classic.
So I wonder if Lamb Weston has enough workers, and we're going to get a read on the labor market tomorrow, and this is really going to help be it'll be a key data point. It's backwards looking, but nonetheless, you wonder.
You're like a waffle fry person or something, aren't you?
Why do you say that?
I don't know.
I like sweet potatoes.
Oh,
Sweet potato fries.
The healthy version.
The healthy
we
version.
try and tell ourselves.
Exactly. But the job market, Tim, is going to be important tomorrow,
Yeah,
obviously.
look, that's certainly the question. We are looking backward when we look at that in December. 444,000 is what a Bloomberg survey of economists is expecting. Look, we talked about this earlier in the day, but it doesn't necessarily perhaps change how people are thinking about interest rate hikes or how the Fed is thinking about things. But what if it's a huge miss?
Well, does it matter? Because at the moment, the Federal Reserve really focuses in on inflation. I think if it's a massive beat or a massive miss, it will always impact the market direction. And likelihood is, if we see yet again strong jobs growth, that again just means that the market's even more focused on the fact that the Federal Reserve is going to be very much trained eye on inflation, on tamping it down.
But I still feel like they've made it clear that kind of like the labor market is kind of the final piece of that puzzle. So I don't know. I mean, if you get a big miss, I guess, to the downside, does that change the calculus?
Could they say it's just another data point and looking at the long-term trend and some of the comments today that maybe inflation is more worrisome, as we've all talked about, and that a new level of going back to comparing jobs to some of the pre-pandemic era isn't the right benchmark anymore.
And what does labor force participation really look like post-pandemic? And is it a new level? We talk about levels so much, and what does it really mean? Anyway, it's going to give us lots to talk about in addition to French fries on Jobs Friday. All right, that's going to do it, folks. For our cross-platform coverage, our Beyond the Bell market wrap on this Thursday. Catch us again, same time, same place, on radio, on TV, and YouTube tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right. It is Bloomberg Business Week.
I turned it on.
Oh, yeah.
It's
Mine's
weird.
working. Is yours working?
I don't know. It's like my brain's a little fuzzy. Maybe my mic's a little fuzzy. Or maybe I didn't turn it on.
Maybe it was my headphones, Carol.
Maybe it was your headphones. So listen, it will be, this will be a different conversation potentially. And if it comes spot on, do the markets, how do they react? How do they read it? Backwards looking, is it Omicron? Is the labor market without the Omicron impact, does it matter because people think we're going to get through this quickly? I don't know.
Remember what it was last month? It was a big woof.
It was
210,000.
It was a big woof.
Last month, and by last month I mean November, the read in December.
All right, so anyway, it'll certainly give us a lot to talk about. In the meantime, she certainly has had lots to talk about, a lot going on in world and national news. Over to Nancy Lyons in D.C.
Thanks, Carol. President Biden says democracy remains at risk a year after the attack on the U.S. Capitol. He blames former President Trump for leading that attack on our elections.
For the first time in our history, a president had not just lost an election, he tried to prevent the peaceful transfer of power as a violent mob breached the Capitol. But they failed.
Biden, speaking in the Capitol Statuary Hall, says it's important now that lawmakers take steps to secure voting rights to prevent Trump loyalists from restricting ballot access in states all across the country. Senate Minority Leader Mitch McConnell issued a statement today saying that Democrats are trying to exploit the anniversary to advance partisan goals like filibuster reform. But Republican Congresswoman Liz Cheney says it's time for their party to reflect on its direction moving forward.
The future of the country is at stake.
Right.
And there are moments when we all have to come together in order to defend the Constitution.
Cheney's father, former Vice President Dick Cheney, went to the Capitol as well today. He told ABC he went there to mark an important historical event. He also said he was deeply disappointed that, quote, "We don't have better leadership in the Republican Party to restore the Constitution." Philadelphia authorities now say they believe yesterday's deadly row house fire may have started when a child playing with a lighter set a Christmas tree on fire. At least 12 people, including 8 children, were killed, 2 others critically injured. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser along with Tim Stenovic. Thank you all out in the social universe who are giving me some support for calling Lab Weston a packaged food company.
What are you getting? You're getting some love on Twitter?
Just some comments.
That's good. I like it.
When it comes to, yes, they do
I love it
do a
when
lot
they
of
get in
French
touch with us.
fries. They do packaged.
But they package the French fries, okay?
Yeah, it's packaged food. It just happens to be a lot of French fries or all French fries. They are based in Idaho. All right, what are we talking about?
Well, let's see. Let's talk a little bit about Well, let's talk a little bit about this is the year anniversary of, the insurrection at the Capitol. It's certainly a somber day for our nation, a somber day in Washington, D.C.
I think about this so much.
Among the most read is a story by our own Mark Niquette that talks about Karl Rove, who, look, fair to say from the old guard, right, more traditional Republicans of the George W. Bush generation, has been blasting Republicans who back Trump's false 2020 claims.
Yeah, exactly. In a Wall Street Journal opinion piece that he put out today, marking that one-year anniversary, Rove asking Republicans how they would respond if, after Trump won the 2016 election, Democrats had claimed fraud, stormed the Capitol, attacked police officers, and threatened violence against GOP leaders to stop legally certifying electoral college votes for Trump. Rove saying Republicans would not have accepted such an action as merely a protest, and calling the rioters patriots. This gets to some of the tensions, the divide in our country.
It does, and it also gets to 2022, and that we're in an election year. And there was a really interesting, I don't have the data in front of me, but a really interesting report on NPR yesterday about the number of candidates for running for state attorney general positions who oppose, who don't believe that Biden was fairly elected. And if you remember back to where we were a year ago, these were the backstop of a free and fair election, right? There were many of whom were Republicans who were actually saying, you guys need to stop. He was fairly elected.
Well, my guessing some of this divide and discourse will certainly continue. You're listening to Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Down Thursday, stocks drifted lower as bond yields remain elevated. The Fed's hawkish stance, a key concern for highly valued stocks. The S&P slumped 4 points today, down 0.1%. The Dow down 170, a decline of 0.5%. Nasdaq lower by 19 points today, a drop there of 0.1%. At one point, the Nasdaq Composite Index was down 185 points, down 1.2%. 10-year down 5/32, 10-year yield 1.72%. Spot gold is down $21 the ounce, $17.88, a drop there of 1.2%. West Texas Intermediate crude up 2.1%, $79.48 a barrel on WTI. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So as the U.S. Capitol was being overtaken by supporters of then outgoing President Donald Trump just 1 year ago today, we really leaned, I should say, on our D.C. team big time to understand and track what happened and continue to do so, really, in the days and weeks after it as well. That included our Billy House, congressional reporter at Bloomberg News, who was at the Capitol during the insurrection. Billy joined us in the days after and shared what was going on as he was in lockdown on that fateful day 1 year ago. Here's some of what he said to us at that time.
I was actually in the House chamber when they slammed the door shut, pulled guns, and rioters were knocking and banging and cracking windows. But I must say, House security performed admirably. They escorted the members out, then they escorted us out, and we were safe. It was an incredible experience, if not harrowing.
Billy House, congressional reporter at Bloomberg News, who joins us right now on the phone from Capitol Hill. Billy, I remember all those conversations with you and was thinking about you and our colleagues who were there. You guys really gave us incredible information, incredible insight. As you look back at what happened 1 year ago, as you hear yourself speaking nearly 1 year ago, and what we've learned and seen in the days after the insurrection, what strikes you?
What really leaps out to me is that there are still elected members of Congress who suggest that was not a violent day, that was not a violent insurrection, and that they expect colleagues who were pinned in that chamber and elsewhere in the Capitol complex that day to sit down and work alongside with them on legislation and other matters, even though they still, a year later, don't accept what is clear on video and what they sometimes themselves actually saw. So that's, if you want to talk about the gulf between the parties in Washington, that's only enlarged what was already a big split before the riot.
Billy, that's exactly where I was going to go, because it does seem like even, I hear comments from some members of the House right now, and it's almost like, January 6, 2021 didn't happen, or they were living in some alternate timeline or alternate universe. Based on your reporting and what you describe, is this something they really believe, or is this what they think their constituents want to hear, and it'll get them reelected?
Well, I'm at the Capitol now, and I just left a press conference with Republicans Marjorie Taylor Greene and Matt Gaetz, and they've just now launched a bunch of scenarios they say they want investigated, that the FBI prompted the insurrection and to either disrupt GOP challenges to the election or to make Trump backers look bad. So that's where we are.
And we can't take that seriously, right?
Absolutely not. But there's the point in what you raised is people they speak to at home and elsewhere. These two actually travel around the country as sort of a, group draw, espousing this stuff, and people apparently believe them, or at least want to believe them. And as we see in polling, Trump is already, with regard to another presidential run, way ahead of anybody in the party. And they're two of his biggest, backers.
Does he speak for the party? And I ask, we just talked about a story about longtime Republican strategist Karl Rove, who is blasting Republicans who back that Donald Trump, the false 2020 win claims that he made. Who is the voice of the Republican Party today?
Well, I'd say the most obvious and most active are those two Republicans appointed by Pelosi on the January 6th House committee investigating what led up to that riot and what occurred that day. Liz Cheney, the former vice president's daughter, and of course Adam Kinzinger of Illinois. But they are outliers in their own party, maybe even seeing their final. Kinzinger is not running again at the end of this year, and Cheney's facing not only opposition from Trump, but at home backers. Opponents that Trump backs. But they are the most out front. But they themselves are seen by many in their party as outliers.
Well, we should note that Illinois Republican Representative Adam Kinzinger, who you just mentioned, he's going to be on Sound On with Joe Matthew starting at 5 o'clock today, so we'll be sure to listen for that. You mentioned Representative Liz Cheney. Her father, former Vice President Dick Cheney, he was actually at the Capitol today.
That was remarkable and kind of unexpected, but essentially there was a short session of the House, which hasn't been in session this week, called a pro forma, and Democrats were there. Pelosi, the Speaker of the House, gave a few remarks, but only Liz Cheney was among sitting members of the House, Republican members, in the room. But her father was with her, the former vice president, and that was kind of moving. They sat together, and afterward he talked to reporters about how proud he was of his daughter and how the leadership of the GOP party today, in his view, is nothing like what it was when he was in the House, and he did serve in the House for 10 years.
Hey, Billy, just got about 40 seconds left. What do we, as all Americans, deserve to know? What do you, as someone who was there and have continued to report on what happened, what do we still need to know? Just quickly.
Well, what I think we in Congress has done a pretty good job at is hold hearings, multiple hearings on the security lapses. I think what we need to know is what the January 6th committee seems to be focusing on is the 187 hours that day, minutes that day, in which National Guard was not called to the Capitol.
Yeah.
Reinforcements were not brought in, and who was responsible for that delay?
Well, we certainly appreciate all the work that you and the D.C. team did in keeping us informed and continue to do so. Billy House, congressional reporter at Bloomberg News. As an aside, former President Donald Trump's social media app, Truth Social, expected to be available starting February 21st, according to a posting in Apple's App Store. So it'll continue. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
I'm just going to say it's a wacky world right now. There's a headline crossing. Dow Jones, GameStop entering the NFT and cryptocurrency markets. And Tim, you saw it right away. Stock is popping in the after hours.
Yeah, it was up. Well, now it's up 15% in the after hours.
That's a lot.
Yeah, this is a story that we're going to probably do on Quick Take Stock tomorrow.
Yeah, I'm thinking we're going to do it as well. Hey, in the meantime, we're going to catch up with the author of a new book, Money Magic, An Economist's Secret to More Money, Less Risk, and a Better Life. Lawrence Kotlikoff, can't wait to talk with him. And Charlie, you better be listening because we're all going to be taking notes here.
We absolutely would never not tune into you guys during the afternoons. Here's what's going on. We've got the Dow, the S&P, NASDAQ all declined. Today's stocks drifted lower after swinging between gains and losses as investors reassessed valuations following the Fed's latest signal that it will move aggressively if prices remain elevated. Right to the numbers with the S&P dropping 4 points today, down 0.1%. Red on the screen across the board, by the way. The Dow down 170, down 0.5%. NASDAQ down 19, drop there of 0.1%. Should point out, notable exception today, Russell 2000 up today by 0.6%. 10-year yield 1.72%. Spot gold down 1.2%. 17.89 the ounce. West Texas Intermediate crude up 2.3%. 79.62 a barrel. Now, what about the economic outlook this year? Julie Beal is senior research analyst at Kane Anderson Rudnick Invest.
So I think it's actually a pretty challenging economy looking ahead. We don't have the level of fiscal support that we have had over the last 2 years. So I don't think it's just a slam dunk that the economy is going to be on great footing. I think you have to be very choosy and find businesses that are going to be able to look through this uncertainty because they have strong fundamental drivers in their businesses.
Bed Bath & Beyond shares advanced today despite reporting quarterly sales that trailed analyst estimates. Bed Bath & Beyond up today by 8%. Constellation Brands, the maker of alcoholic drinks including Corona and Modelo, says it expects to hike beer prices more than the typical 1% to 2% this coming year because of rising commodity costs and a shortage of brown glass. Constellation lower today by 3.4%. Again, repeating that Dow Jones headline, GameStop entering the NFT and cryptocurrency markets. I'm Charlie Pellet. That is a Bloomberg Business Flash.
That's right, and that stock is rallying big time, 14% here in the after hours, so keeping an eye on it. Hey, Money Magic, it's a new book out that may make you think twice about the conventional thinking that we've really heard about for decades when it comes to financial advice, and that includes areas like home ownership, life insurance, cashing out your IRA to pay off your mortgage, and why you might want your daughter or son to grow up to be plumbers rather than head to a pricey private college. Something to think about for your own son. I've
heard some of this before.
My plumber owned so much real estate and retired really early.
Yeah, well, I just paid a lot of money to get a drain cleared, so I'm rethinking my profession as well. Lawrence Kotlikoff is professor of economics at Boston University. Larry joins us on the phone from Boston. Larry, how are you?
Great. Thanks for having me, guys.
So what is the biggest thing that we're getting wrong when it comes to conventional wisdom when thinking about retirement?
Well, there's so many things we're getting wrong. We're not saving enough. We're retiring too early. We're taking Social Security too early. We think we should get out of the stock market in old age when economics actually says you should, as you're going through retirement, you should be putting a larger and larger share of your dwindling retirement assets, fungible assets, into stocks.
Tim and I were just talking about this. Remember when it used to be like your age minus, and that would, figure out how much should be in fixed income versus the equity markets? Anyway, please continue.
That's another one of the rules of thumb of the conventional financial planning. But we also need to understand that we should be timing the market for risk. When things are riskier like they are right now, we don't know whether the economy is going to be able to absorb all the illness from Omicron, even though any one person may not be as likely to die. That's more risk. So we should be cutting back on our stock holdings in times of risk.
So
that's actually what we see happening. Yep.
Yeah, and we do, right? We've seen a fair amount of money pulled out in a big way. Certainly when we talk about the $1 trillion route that we've seen in a lot of those technology names just in this first week of 2022. when you sat down to write this book, why did you want to do it specifically? Because you really talk about when it comes to living standards and these financial decisions that we can make can really impact our living standards going forward.
Yeah, Wall Street is focused on our wealth, and economists are focused on our welfare. Our welfare connects to what we get to spend and our living standard. And economists have been working on personal finance for 100 years, starting with a work of Irving Fisher in the 1920s, the Yale professor. So I got into grad school in economics because I wanted to help. I thought it could be a field that could help society. And I realized, working a lot on personal financial issues, that what was being conveyed to the public as advice was complete right angles, completely at odds with what economics was recommending on in every area, whether how much to save, when to retire, when to take Social Security, how to think about your longevity risk. Just completely across the board, it was all oriented towards product sales when it came from conventional planning, economics. And then you had economists basically never talking to the public because they didn't have a clear idea of what precisely to say, and they didn't think it was their job to actually prescribe solutions. But I've been working in developing personal financial software. We have a tool called Maxify.com, Maxify.com, that I've been working on for 30 years, developing the software, which does deliver the economic solution. But no, most people don't want to run software. So I said, let me take everything I've learned over the years from economists, from the software, from my own research, put it into this book, and that's where I'm coming from, to help people.
So I'm just at Max. I'm looking at the planner right now. It's really interesting, Larry. I'm wondering, how people can put your lessons into practice. I mean, what's a practical way to think about the advice that you've learned over your career?
Well, I mean, the book. If they bought the book, if they don't want to actually, run the software, they buy the book. The lessons from the software are primarily, mostly in the book. So, what we're trying to figure out in economics is how to have a smooth living standard, how to raise your living standard safely, like doing smart things with respect to Social Security and retirement accounts to lower your lifetime taxes, how to price decisions. If I'm thinking about buying a new boat, how much is that going to cost me? A big boat. Not a new boat, but a big boat.
Yeah.
How much is that really going to cost me in terms of my ongoing living standards? So I need to understand that trade-off in order to decide whether it's worth it to me. So pricing risk, but also when it comes to investment, understanding the range of my living standard outcomes. Wall Street is focused on your saving, what you're currently saving, you're spending some targeted amount that has no connection to what you actually can afford, and then accumulating this stuff up on a Monte Carlo simulation, simulating whether or not you run out of money. But economics says you're going to adjust your spending all the time.
Right.
And so therefore we have to look at the trajectory of your living standard paths.
Larry, hang on for a second. We're going to do a little bit of news, but we do want to come back and continue with you. Larry Kotlikoff, professor of economics at Boston University. He's got a new book out called Money Magic. We'll continue in just a moment.
Well, let's check in with Nancy Lyons for check the latest world and national news. She's standing by in D.C. Hey, Nance.
Thanks, Tim. President Biden today commemorated the one-year anniversary of the attack on the U.S. Capitol by warning democracy remains at risk as the memory of that day lingers.
We saw with our own eyes. Rioters menaced these halls, threatening the life of the Speaker of the House, literally erecting gallows to hang the Vice President of the United States of America.
Biden blamed Donald Trump for the attack, calling him out not by name, but by the title, former president. Biden said for the first time in the nation's history, a president not only lost an election, but tried to prevent the peaceful transfer of power. As a violent mob breached the Capitol, he says it was the former president who rallied the mob to attack while he sat in the private dining room off the Oval Office, watching it all on television and doing nothing. Republican reaction to President Biden's speech is as mixed as the divide within the party over former President Trump's role going forward. Bloomberg's Nathan Hager reports.
Longtime GOP strategist Karl Rove wrote a piece in the Wall Street Journal asking Republicans how they'd react if Democrats had attacked the Capitol claiming fraud after Trump's win in 2016. Rove says there can be no soft-pedaling January 6th. Republican Senator Lindsey Graham reacted on Twitter, accusing President Biden of, quote, brazen politicization of January 6th. And former President Donald Trump himself put out a series of statements accusing the president of using his name to further divide the country. President Biden did not say the words Donald Trump in his speech. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, Tim Stanovic here on Bloomberg Business Week. We're talking with Larry Kotlikoff, Harvard-trained economist, New York Times bestselling author. He's got a new book out, Money Magic. Excuse me. I told you I'm ready for Friday. Money Magic and Economist Secrets to More Money, Less Risk, and a Better Life. Larry, we've just got about a minute and a half, and then we'll come back and continue with you. But you go through so many conventional, so much conventional wisdom when it comes to financial planning. Give us one thing that you think might just shock people that they're told to do but we shouldn't be doing, or that they should do that we shouldn't be doing.
Well, like cash out your IRA that might be in the stock market right now and use it to pay off your student loans, your credit card bills, or your debts, or your mortgage. That's unusual advice, but that can make a middle-class household $100,000 in lifetime present value increased spending. There's just one shocker after the next in this book, because so much of conventional wisdom is so far from appropriate.
But if you cashed out your IRA, you'd face penalties, right? You'd face stiff penalties, not just in taxes, but in...
So I'm talking about, so there's an issue. It's not for everybody, and I talked about that, but if you're in maybe you've been furloughed, maybe you're over 59, so there's no penalty, you are going to have to pay taxes on it, but the advantage of once you risk adjust the stock market return, it's just the bond market return, and therefore there's a clear arbitrage opportunity. You said that the long-term Treasury was like 1.7%, right?
Mm-hmm, right.
Well, if the mortgage rate is 3.5%, there's a differential there you can pick up with no problem. With complete. So when you risk adjust the stock market, it's really 1.7% you're earning in the market. So that's why we need to do an apples-to-apples comparison when we're thinking about these kinds of things.
I know another one is
you have to do the risk.
Owning your home lowers your taxes, mortgaging your home raises them. And maybe we'll talk and dig a little bit more into them, because I really do think these are things that we've been hearing, and yet you really are putting a spin on it and a new way of thinking. We're going to come back with Larry.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. GameStop shares now up 17% after hours. GameStop said to be starting an NFT unit to develop a marketplace for the tokens, as well as creating crypto partnerships. This according to Dow Jones, citing people familiar with its plans. Dow Jones says GameStop has hired more than 20 people for the effort, which will include a hub for the buying, selling, and trading of video game NFTs. T-Mobile US exceeded Wall Street estimates for fourth quarter subscriber growth, reporting 1.8 million new wireless customers. Stocks drifted lower today as bond yields remain elevated. 10-year yield 1.72%, 10-year down 5/30 seconds. S&P lower by 4 today, down 0.1%. The Dow dropped 170, down 0.5%. Nasdaq at one point was down 185 points, ended the day with a loss, down 19, drop there of 0.1. Spot gold down 1.2%, $17.89 the ounce. West Texas Intermediate crude up 2.3%, $79.61 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We want to get back to our guest. Still talking with Larry Kotlikoff, New York Times bestselling author. He's professor of economics at Boston University, also a research associate at the National Bureau of Economic Research. He's written a ton of books. His latest book, Money Magic, An Economist's Secrets to More Money, Less Risk, and a Better Life. Still with us on the phone from Boston. Larry, I'm going to toss it over to Tim because we've been having a conversation about what you just said for some of our audience. And let's remind everybody what we asked them about.
So we'll remind you, Carol asked you about something that was provocative that's in the book, and you certainly delivered. And you talked about cashing out your IRA to pay off a mortgage. And I guess I'm having trouble making the math work because if I'm understanding the logic here, you're taking money from your IRA, you're taking it out of the stock market or asset allocation that includes stocks and fixed income, and you're putting it into a different asset that you're paying off a small portion of each and every month at an interest rate that is really, really low by historical standards.
Yeah.
I don't understand.
It's really, really high. It's really, really high compared to the safe rate of return that you can earn in the market right now, which you said just on the show is 1.7%. I guess on 10-year, 10 or 30 years. I forget what you said. 30-year bonds. So if you got a 30-year mortgage and you're comparing that, maybe borrowed at 3.5% versus you can invest at 1.7%. There's an arbitrage opportunity here. So why am I focused on the 1.7? Because you can risk it. You have to risk adjust the stock market return. The stock market historically has yielded about 8 or so % above inflation, that's a long way away from what you can earn on. But that's just an average. There's a huge standard deviation in the stock market, huge fluctuations. So people are saying this thing is true. If it was perfectly safe to be in the stock market, nobody would be investing in the bond market at this ridiculously low rate. Mm-hmm. So that's why you need to risk adjust so we can do apples to apples.
So tell us about some of the other thinkings that you get into your book, and you talk about specifically, you get into Social Security. You talk about, something that Tim and I have talked a lot about. I just sent a daughter off to college, and higher education, especially from private institutions, it's really expensive. You're talking $70,000, $80,000 a year.
Yeah. And I say, I have a chapter entitled "Don't Borrow for College." There's a chapter on, marry for money. There's a chapter title about divorce, basically, how to divorce without going to divorce war. So the book really covers the entire gamut of personal financial decisions. As for college, there's evidence that going to Harvard relative to some other university is not going to matter much to your career earnings because it's how well you work and how diligently and how creative you are. I mean, Harvard collects really, special people who are very good at working, very hard, and also are, talented in other ways. But it doesn't necessarily add any value to them. So why should you pay for, $70,000 a year when you can, have the same career if you go to Wake Forest at a much lower price? I'm not sure Wake Forest is cheaper, actually, so I'm just throwing that example out. But that's the idea. Let's shop around for a school that's affordable. 40% of the kids that go to college never end. never finish. So if you borrow for the luxury of dropping out of college, this is crazy. Who borrows money to invest in something where they know right at the get-go there's a 40% chance of getting nothing?
Yeah, that's it. No,
So that's why there's a chapter called "Don't Borrow for College." It's very strong, strong language warning people off from this.
You know, so one thing that I've been thinking a lot about is what the present environment means for people who are early in their careers right now, people in their 20s and 30s, because we have seen really historically high returns in the S&P 500 in the last 3 years, and how people should be thinking about retirement. So what advice would you have for people who are in the earlier part of their careers? Maybe they don't own homes yet. Maybe they are still at the beginning of saving for retirement and planning their financial futures. What should they be doing that conventional wisdom says they shouldn't be doing?
Okay, so the stock market has done fantastically of late, but it's also done fantastically poorly over the, in the Great Depression went down 86%, went down 50% or more in the Great Depression and the Great Recession. It's had bad times. And so I would say, look, if you're starting out, make sure you put enough into your 401k to get the employer's match. That's free money. After that, pay off any student loans, any credit card, don't carry around large credit card bills. And then buy a house with as much cash as possible, because engage in safety first behavior, and then beyond that, invest in the stock market in a diversified way, as well as other things like REITs and bonds. I'd be very careful about inflation. I think this government is so broke beyond belief that we're going to have inflation out the wazoo through time to pay off the government's, the government is going to print money to cover its spending, because this is what governments that are broke do. And our country is as broke as any country in the world that's developed. We're not Zimbabwe or Venezuela at this point, but we're in very bad long-term shape, fiscally speaking.
I'm so interested in your book. One of the other things you find out, and here's a line, everyone, that will make you probably want to just read the whole book. You can't count on dying on time. Longevity is likely your greatest financial risk. I mean, we really need to think about this, Larry. I have a brother who was like, how do I know enough is enough? Like, when do I know enough is enough? Because he had an advisor who said, you're good. But it's tough.
Yeah. It is tough. I mean, let me just give you, it's one of the things I talk about in my book is buying an annuity for my mom when she was 88. So my mom was, my brother and sister, my brothers, my sister ran a bunch of major companies, and my brother's the provost at Cornell. Both of them thought buying an annuity for my mom at 88 was crazy. Right. I went to the principal life insurance company. They said they've never sold an annuity to anybody that's old. So I got an inflation indexed annuity for her. And they said she's not going to make it beyond 4 years, and she did. She made it to 98, and it was great that she made it, and it was great that we had the annuity to help with that.
Well, we could talk, and forgive me, we're running out of time, and I wish hopefully you can come back at another time, because I think this is really provocative and
anytime.
Larry, good luck with the books. Larry Kotlikoff, he's professor of economics at Boston University. His new book is Money Magic.
Well, let's head to Washington, D.C. and check in with Joe Matthew, who I know is planning a big episode of Sound On at 5, excuse me. Joe, what's coming up?
Yeah. Well, thanks, guys. It's been quite a day here. Just reliving this. Sure, it's been the same for people everywhere. Reliving the sights and the sounds of a year ago today. It started early with the president's speech this morning and has kind of carried through the day with commemorations on this January 6th. We're going to be speaking coming up, though, with Congressman Adam Kinzinger. This is one of only 2 Republicans on the House Select panel who has been criticized by many in his own party for investigating what happened that day. Just one of the lawmakers joining us this 1 year after.
Well, looking forward to the coverage. And I was saying to folks earlier, 1 year ago, it feels like 10 years ago in some regards. A lot has happened in between. Good luck. Joe Matthew with Sound On coming up. For Tim Stenovic and the whole Business Week team, have a good and safe evening, folks. This is Bloomberg.